trading, and you can see this across the board, even in the NASDAQ, where you are seeing a bit of strength in the earnings, or not a bit of, tremendous strength. You're still seeing that sell-off persist.
Yeah, the sell-off's there, and again, it might work this morning off the Bloomberg terminal. The Bloomberg Professional Service was simple. The bank stocks are grim, and I rarely use that word. I'm not like you, where you throw it around like it's a, Kit Kat on Halloween. But the answer is, it's like, Lisa, these are not pretty charts on any number of ways. Technically, where's the bid? Who's going to step in there?
So you hand out bow ties, and I just hand out little slips.
No, I ran out of candy.
Grim.
We mentioned this earlier. If you weren't watching, watch, please. These are important moments here. And the answer is I ran out of candy. So, we gave out whole bow ties. It worked out great.
Let's finish going through what we see right now in the markets. 10-year yield is just marginally lower, but still a 4.9%. Real feel of really moving upward. I really can't say enough about Mike Schumacher, what he was saying. This will make the difference when we get the refunding agreement in 25 minutes about whether he gets bullish or bearish. A bit of euro softness. S&P futures down 0.4%, 41.96. Not able to break through that 4,200 level after 3 consecutive months of declines. And honestly, Tom, crude, we've been looking at just fluctuations here, even amidst a very difficult geopolitical situation pocked by incredible human tragedy.
Well, the human tragedy is there, but, through the beginning of the war, I believe October 7 is the date I'm going to put on that. And the answer is I'm looking for West Texas Intermediate, the lower priced of the 2 oil prices. Are we going to see a 79 handle on American oil? We're not there yet. But did I think we'd see that a week ago or a month ago? No, no, no.
Are we being driven by strength, or are we driven by supply? That is a story for oil. That is a story for bonds. And arguably, that is a story for a lot of the underpinnings of corporate America. Ann Miletti joining us now, head of active equity at Allspring Global Investments, formerly Wells Fargo. Ann Miletti, how much are you looking at earnings coming out and getting a signal for how pessimistically a lot of traders are treating them?
It's a great question, Lisa. And I, would have hoped, I think that earnings season would have brought more clarity, but I don't think it has. The reality is, when you look back, earnings have, for the most part so far, and we're only about 50% in, have met expectations. You're seeing a little revenue growth and about 4% earnings growth on what's been reported so far year over year. But the more challenging thing, as you pointed out, is really the outlook. And it's pretty murky when you talk to the CEOs and CFOs, and that's what we've been hearing prior to earnings season as well. So you're not getting any more clarity from earnings than you are from the economic data.
So given the fact that you're not getting a lot of clarity and sentiment is bad, do you just lean into that and go with the flow and kind of shift away from that and hide out in whatever haven you've designated as actually being a haven?
I think, it's a really important point. And I think, I've been spending a lot of time thinking about this, and, a pretty long history of doing this. It really feels like right now we're in a transition period, moving away from an economy that looked very different into one that is clearly different as well, with higher inflation and likely higher rates. And when you're in those transition periods, as we are now, it is pretty, murky. It is hard to figure out exactly the right direction. And then layer upon that the pandemic, QE, all the fiscal spending we had. It's really hard to make comparisons to any type of market past. And so that adds another layer of complexity and frustration for investors.
And should we be diversified here or have more concentrated active management bets?
I do think it's time to do both, Tom, and that might seem odd to you, but I think as an investor, you want to stay diversified in this kind of environment, across sectors, across countries, across asset classes. But certainly, I definitely would lean, and of course I have a bias toward active management here, because you don't want to own the whole index and any of the indexes today. I think that's been proven.
Okay, what do I not want to own? I mean, I know I don't want to own the AAA organization of the Milwaukee Brewers. I mean, we don't want to own that. But what else do I not want to own?
Yeah, I think right now what you don't really want to own is some of the really high multiple stocks. There's more downside risk than there is upside at this point when there is uncertainty. I think you don't want to own companies with a lot of leverage that have to go back and look at more financing at a higher cost, clearly. And I think you have to be really, really careful to own, if you're owning, especially in the small cap space, which I'm kind of a fan of actually, you have to be really, really careful that you don't own companies that don't have a leading advantage in their space.
I mean, and you've been doing this for like 7 or 8 years. I mean, is this now the time to load the boat on the bank stocks? I mean, you mentioned small caps, so let's go from, the 7 or 8 giant banks, you got the regionals and all that, and then you got thousands of banks beneath them, which I know Allspring researches every day. Is it now the time to load the boat on banks that look grim?
Look, I talked to almost all of our equity managers yesterday, in fact, and this question came up. And I think the answer that I got was, it's not time to load up the boat yet. If you are going to own banks, you do want to be very, very selective in the banks that you own. And I think, some of your former guests just talked about this as well. We will see if there is more damage to be done. It's based on the same principles that I talked about. How much is this changing environment really impacting banks? And I think we will see some that will fare just fine. And I think Ed Yardini's point about consolidation is true. That's coming around the corner. But it's a pretty difficult time to tell investors to load the boat here.
And just to finish up, we're about 20 minutes away from this refunding agreement announcement, by the Treasury Department. Do you plan on trading it in any way?
I think, it is something that we look at, but again, as active stock pickers, we're really focused much more on bottom up fundamentals. That has served us well throughout the years. And obviously you pay attention to the macro and all of these other dynamics, but focusing on company fundamentals, I think as we get out of this transition into the next cycle, it's going to become a clear winner. So that's where we're focused.
What are you hearing with cash? I mean, I'm absolutely fascinated by the dynamic of deposits to money market funds. It means a lesser banking system and all. How do you handle cash at Allspring in a, managed portfolio, long only buy side portfolio?
Yeah, I mean, cash is, as an allocation for investors, and Tom, this with your triple leverage cash portfolio, it's been more attractive. But within the equity portfolios, our job primarily is to invest in equity. So that's the main purpose. Cash is in kind of the what's left over after those decisions are made. Typically, we see cash levels below 5%, but our investors are allocating cash away from, into different buckets and away from the active managers, if that's what they're looking to invest in. So it's not really our focus.
Amelie, thank you so much. With Allspring, of course, with all sorts of consideration of value over the years. Amelie of Allspring in Wisconsin. They were the strong group, and they owned the high ground. There was a value moment where Strong really owned everything to do with value. And as you mentioned with the small caps right now, I think they're values. I don't know if others should buy them or not, but wow.
This has been a very difficult one to get right. I mean, we heard Ed Yardini say the reason why he's not necessarily going all in is just because he's gotten burned on it, as have so many other people who say there is value here. Lori Calvasina saying the same thing. They look really, really cheap, and yet that sort of pesky sentiment driver really hasn't helped.
All these narratives that we have, no one is more front and center than our Bloomberg International Economics and Policy correspondent. Michael McKee kicks off 3 days of coverage now. It's the McKee Hour here, and we're thrilled that he could join us this morning. Mike, all sorts of narratives here. We're going to have some good time to talk to you through today, Thursday, and into Jobs Day on Friday. Let us start with ADP here in less than 2 minutes. Do you care? Is there a new veracity to their study of paychecks?
No. And they would tell you that there isn't supposed to be, that it's now an independent indicator, doesn't predict anything in terms of non-farm payrolls. We always say on ADP Day that we care about it because the market cares about it. But unless there's some really weird number today, I don't even think the market's going to care about it because there's so much else going on. So many other numbers out today, plus the Fed and the refunding.
Well, we're going to get to the refunding in a moment. We're going to line up the ducks here with McKee, of course, into the press conference. this afternoon. Is the vector in place, Mike, very quickly here, is the vector in place for a more miserable job economy? I don't see it.
Nor does anybody else. The forecast at the moment for Friday is 180,000 jobs, which is still a very high number, way above what the Fed thinks is sustainable. So the market seemed to have thrown in the towel a little bit because we keep getting surprised every month, and they're accepting the idea that it may still be strong. And we'll get a better look when we get jolts at 10 o'clock in the Eastern time this morning. But when you look at what else is going on in the economy, and you look at what we saw in terms of the ECI the other day, wages up, it does suggest still a strong labor market.
Michael McKee with us in Washington. Let me reset. We say good morning to all of you on Bloomberg Radio and Bloomberg Television. We begin really a three-day narrative here of the state of the American economy. Futures negative 15, Dow futures negative 108, and I believe somewhere in the vicinity of right now, we have an ADP report. Michael, what do you see?
We do have an ADP report, and it is a bit weaker than people had perhaps anticipated. 113,000 jobs created in the month of October, according to the ADP folks. The forecast on that was for 150,000, but remember, ADP called for 89,000 last month, and we ended up getting over 300,000. So take it for what it's worth. Now, what ADP is saying is that the goods producing sector produced 6,000 jobs, manufacturing up by 3,000. They had gone through a string where manufacturing was losing jobs. Construction, 4,000. Service providing jobs up 107,000. The leisure and hospitality is 17,000. Education and health services, 45,000. They always kind of lead the way there. And then in terms of establishments, it looks like medium-sized businesses, 78,000 additional jobs is the leader there. Pay insights, they now have this pay component. Overall, those who stayed in their jobs saw raises of 5.7%, and those who changed jobs, 8.4%. So still strong numbers in terms of wages. Fits with the ECI number that we got in terms of explanations. But is it going to matter? Probably, as I say, not.
The market move here, equity markets improved from negative 15 up to negative 12 on SPX. These are little tiny moves. Two-year yield gives me some love. We moved to 5.05%. We're now, well, a lower yield there of 4 basis points. I don't know what to make of that. This morning, 2-10 spread for a moment. I had 15 basis points, which, you know, Lisa, I mean, you know, help me here. I'm trying to make something out of the ADP report.
Well, to me, it's interesting that there is a move at all, because a lot of people basically shrug off the ADP as not having any kind of leading indication for what we're going to get on Friday from the jobs report. But the fact that it came lower than the expected 150,000, that it came in at 113,000, giving a boost to the idea that maybe yields are going to be topping out here, and that maybe you're going to get a boost to equities.
Mike, let's move right on here to 8:30. I want you to give us a clinic on the refunding. Folks, full disclosure, McKee riveted by this, Keen not so. Peter Fisher, ages ago, Mike, would say, we're not going to have Janet Yellen in the Treasury try to make a bet on the bond market. Is there any history where the Treasury, back to Gallatin, bets on the bond market, bets on the curve?
Well, define that how you will. Over the years, Treasury has termed out or brought in their buying depending on what the outlook for interest rates is. In this case, they have up to this point been concentrated across the curve, which has put a lot of stuff into the long end. They're getting criticism for it because obviously rates have gone up a lot recently. So it'll be interesting to see what they do at 8:30, whether there's a significant change or not. But basically, the Treasury is in the position of having to refund a lot of paper that's maturing and add in additional cash because the deficit is growing. So they've got to figure out the best way to do it. They've always argued they should be regular and predictable, and that at the same time, they want to be the lowest cost provider of loans to the government.
Mike, can you just quickly tell us which indicators are the most reliable that we've seen this week? ECI, we're going to get JOLTS, we just got ADP. What's the best forecaster for Friday's number?
Well, oddly enough, Lisa, for Friday's number, a lot of people like to look at the conference board, jobs hard to get, jobs easy to get numbers, because they tend to reflect people's experience out there, and they were reasonably good. We've talked about ADP. The ECI numbers are only quarterly. The Fed looks at those very closely in terms of detailed data,
Right.
but as I say, only quarterly,
Right.
so they're not going to give the Fed a lot of information about what is going to happen going forward. 10 o'clock, we also get the ISM manufacturing numbers, and they have a pretty good track record. So there is some reasonably good data to try to build your forecast on for Friday.
Mike, the markets move off ADP. I don't know what to make of it. My head's spinning on this. A 2-year yield in 4 basis points, 5.05%, in 4 basis points in the 10-year yield. Maybe a little better framework to equities here in the last number of moments. Michael McKee, are we going to get surprises at your press conference today? I mean, we do the press conference for McKee, but Mike, everybody's telling me snooze fest and all my radar's up. I just don't buy it. What could be the surprise we see this afternoon?
Well, if Jay Powell put any kind of specifics to the idea of whether the Fed is done or not, or whether they are still considering rate increases, I suspect he'll come out and say it's still on the table, but we paused today. Obviously, Tom, if the Fed raised rates today, it would be quite a shock to the markets. But there's no dot plot, there's no new economic forecasts, so there's not a lot of news except for the decision and then what Jay Powell says about it. And historically, he's been reluctant to say anything that leads the markets too far in any one direction.
Where's the famous McKee dissent meter today? I mean, it's not like, you know, at least I love what they do at the Bank of England and the ECB, where there's like some really visible screaming and yelling. But I guess, Mike, that's rude in America, right? There's no dissent.
Well, it's become sort of traditional in the U.S. that the Board of Governors doesn't dissent at all. We haven't had a dissent in years from them, and the presidents only dissent on very rare occasions, and it doesn't appear that anybody is out of line this time. Nobody has spoken up in the intermeeting period saying that the Fed's doing the wrong thing, so I wouldn't expect any kind of dissent here. What would be fun is if we got something like the Bank of England, where everybody's vote is publicized, and you get sometimes 3 different votes or 4 different votes. But
like that.
in this case, we will probably get a united number.
If you are just joining us, we did get the ADP employment change that came in a little lighter than expected. This comes ahead of the JOLTS job openings report that we get at 10 a.m. It comes ahead of the jobs number that we get from the non-farm payrolls on Friday, and it comes ahead of a Treasury refinancing agreement that is just 8 minutes away at a time of real fraught tension in the bond market. And Tom, you can see that bonds are moving and stocks are responding in tandem. Basically, yields are slightly lower, stocks slightly higher. There is a feeling any softness in the U.S. economy will be welcome in this market.
We're starving for data, and you know, this is something we haven't talked about enough, which is the ISM data. Michael McKee, help us with ISM. This is John Farrow. John Farrow screams about this. He bores me to death. We're having breakfast, you know. We're at Greer's, and you know, we're having the little chewy things that they eat there with at Greer's, and you know, Mike, you know, I just, why is Farrow all wound up by ISM? What do you get out of ISM on the first of the month?
Well, the biggest thing about ISM is it's been around since the 1930s, so there's a long track record, and you can compare it to economic cycles. So it does have relevance in trying to figure out what's going on. In this case, everybody will be looking at the top line number, of course, to see if manufacturing is still strong in the U.S. compared to the rest of the world. But underneath that, you'll get an employment number that people can use to help calculate Friday, and then we'll get a prices paid number. And that's the number that everybody's been focused on in terms of whether or not we are seeing inflation continue to cool.
Michael McKee, thank you so much from Washington. Extensive comments there on the set of narratives that we have driving forward to Friday. We got a little bit of time here, and joining us now is the global chief economist at Morgan Stanley, Seth Carpenter. So thanks for showing up, and we're going to have you afterwards, after the 8:30 refunding and all that as well. You got to go in right now and say, good morning, Mr. Pick, sir. Wonderful to see you, sir. What's your message to the new minted leader of said firm?
I think one of the first things is it's great to have such great continuity within the firm. But this is a funny week, right? This is a week where we have a Fed meeting and a Treasury refunding meeting, and the Treasury meeting's probably more interesting to markets. That doesn't happen all the time.
Oh, come on, Peter Fisher would say it's going to be a non-event. Why is it going to be an event?
So maybe it will be, maybe it won't be. I remember, though, when I was at Treasury, when I was sort of running the financial markets office, and I would do the press conferences at the refunding, and we tried as hard as possible to make it boring and anodyne and not make news. But now everyone is asking, are they going to upsize the coupon auctions by how much? I think that's a real question now, as the markets are so obsessed with where's the long end of the curve going to go. People are looking for any clue they can get their hands on.
Where's the bid? I mean, are you looking at a given nation coming in with a bid? Are you looking at a sovereign wealth fund? Are you looking at mom and pop in Topeka?
Well, I think it's going to have to be a little bit of everything. Most importantly, though, from our perspective, and we saw the ADP numbers, I think Mike said they were a little light. We'll see what's going on with...
She gave me all the questions.
Fantastic. You did very well, Lisa. You know, what we think at Morgan Stanley is going to drive things even more is just going to be if we get the slowing in the economy that we're looking for in the fourth quarter, then people are going to go, okay, we found a top on yields. Now that we're going to have to reorient a little bit.
What's 20 seconds? What's Ellen's number for Q4 right now?
For Q4 GDP growth?
Yeah.
We're down. We're somewhere around, I think, 9/10. So a bit of payback.
Under 1%?
A bit of payback. Well, to be clear, Q3 was a gangbusters number, right? And so we're looking for some payback, especially in the consumption number. But we've also seen weak investment numbers. That's sort of not a great harbinger. And inventories added 1.3 percentage points in Q3. That's just not going to follow through.
Next year for Halloween, I'm going as a refunding.
Oh, yeah?
Yeah, refunding event.
I'm going to go as Tom Keene watching auctions.
Yeah, well, that's a dark black suit. Don't get hit by a car. We are honored to have Seth Carpenter with us with the many narratives of this very busy Wednesday. He is with Morgan Stanley. Futures -14. Good morning on radio, on television.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Bloomberg surveillance, Tom Keene, your clues. Bramo on top of the story, refunding right now. We're with you without commercial interruptions through this half hour. We deem it so important here. Waiting for the headlines. Futures negative 13. A little bit of move off ADP and then a churning to the markets as well. The many narratives that we see here on the 1st of November. And of course, the 10-year yield 4.90%. A stream of headlines, and 4 of them have the famous Michael McKee red sticky. Michael McKee on this refunding. Mike?
Yeah, let's put the fun back in refunding, Tom. Here are the numbers for Treasury. $112 billion is what's going on the block. That's $9 billion more than in the previous quarter. Of that, $102 billion is basically the refunding and new cash, $9.8 billion. Most of this work is being done by the shorter end. 3-year note yields, 3-year note auctions rather, going up by $48 billion. 10 years by $40 billion, to $40 billion. I'm sorry, these are the offerings. And the 30-year bond, $24 billion offered. All of those larger coupon sizes than had been auctioned in previous quarters. The quarterly increase that we get is basically concentrated at the short end, which makes sense since long end rates have gone up. The problem, of course, for the Treasury Department is that people are criticizing them for not terming out earlier. They have to pay more, so they are kind of locked in here at the higher rates rather than being able to take advantage of any falling rates. And they do say that this may be the end of it in terms of raising auction sizes. They may raise auction sizes one more time, and that should be enough in the first quarter of next year. They're going to maintain their bill auction sizes at the current rate, so still a lot of work being done by the short end. By early December, there will be modest reductions to bill auctions as they realign the borrowing needs with borrowing. That'll go till late January, and then they are still working on the buyback announcement. Nothing today on that. That will come a future refunding, they say.
The market likes what it sees. 2-year yield comes in sprightly here, 5.05%. 30-year bond at exactly 5% right now. Equities improved, negative 14 on S&P futures, down negative 7. So there is some movement to the market. Maybe a little bit of dollar weakness. I'm really forced on that, and the same with oil as well. The real yield, the 10-year real yield was at 250 early this morning. Some angst there. Now back down to 244. We welcome all of you on radio to television with something Bramo cares about. What's your thoughts, Lisa?
Honestly, I'm watching the 30-year yield get really close to punching through 5% for the first time in a number of days. But to me, this is really the story. The Treasury Department came out. They gave a nod to market move, if nothing else. A lot of people are going to basically suspect that was the case. Front load a lot of their purchases in the shorter end, and then end up on the longer end not raising the debt sales to try to pressure some of what we have seen in terms of messiness. Mike, just quickly here, what we're seeing is a rally, and this is what a lot of people are expecting. We heard this from Mike Schumacher. How much are people going to suspect that the Treasury is directly responding to fears about disorderly auctions and some of the volatility that we've seen at the long end of the yield curve?
Well, they likely are. Whether or not it's because Wall Street said it or because it's pretty obvious is open to somebody's interpretation. One really interesting note comes in the Treasury Borrowing Advisory Committee letter to the Treasury Department. These are the traders from all the top Treasury houses around Wall Street. They note that the rise in yields that we have seen in recent weeks is likely because traders are repricing for stronger growth and at the same time for a higher neutral rate from the Fed. They are not putting a lot of weight on the idea that it is the deficit. So Janet Yellen said it wasn't the deficit, and they seem to be agreeing, the folks who deal in these things day to day.
Nicely encapsulated. Michael McKee, thank you so much for the brief, really, truly over the last couple of days here on refunding. With us, Seth Carpenter, and McKee segues perfectly, folks, to the chief global economist at Morgan Stanley. Is this just about an R start? Are we all John Williams this morning and we're readjusting? I had Claire with me last week at a Bloomberg event. 2.0% is not 2.6%. I mean, are we really talking, as Mike alludes to there, about a new inflation regime?
I think you want to separate out a couple things. One is the new inflation regime. And there, if you're comparing it to where we were from the financial crisis through COVID, I think you have to say yes, right? The Fed was consistently missing its inflation target to the downside by, call it, a 1/4 percentage point. We're clearly above target now. And over the next several years, they want to bring it down. But I'm not sure they want to go back to the old days of, being below 2% on a regular basis. So if they're going to be averaging a little higher during expansions, call it a 1/10 or 2 above, you're talking about 25 to 50 basis points higher inflation, so that's got to be there. I don't think we're talking about the difference between 2% inflation and 3% inflation.
I want to tell you on radio and television where we're heading here. What a half hour we have. We have Dr. Carpenter with us on the broader economics of this moment. Ira Jersey scheduled to join us, just exquisite here on fixed income dynamics. And then we do even better. Mark Cabana is going to darken the door, who's just expert on your world about, the different tranches of the auctions.
I want to dig into what the implications are of this announcement, Seth. And to me, I'm looking at the idea that they're really going to force the front end to do a lot of the heavy lifting here. Does that pose a greater risk than people realize?
So my view is no. The way I would think about it, there was a speculation that back and forth a little bit earlier, did the Treasury just react to the market? And I think you want to remember that the folks there at Treasury, Josh Frost, the Assistant Secretary, the career staff in debt management, they have a structure now. They have a framework for how to think about what to issue, and they're looking at what is the market saying about where the market wants to pay up and where the market's demanding a discount. And at the margin, they'll lean a little bit more to where the market wants the paper and lean a little bit away from the place where the market's pulling back. And we've seen over the past several months a big sell-off in the long end. It showed up, in model speak and the term premium. And they're paying attention to that. It's not that 1 week to the next or 1 month to the next or even 1 quarter to the next. Is it sustained?
Well, what we are seeing is very much a strong move on the long end, and that 30-year yield plunging back below 5%, as we were talking about. Do you think that this indicates that really what we're seeing in yields is entirely a supply-driven story more than anything in terms of an economic read on strength and inflation in the U.S.?
So, no, it's so hard to pin it on any single thing. When I talk to our clients here in New York, in London, around the world who are trading in treasuries, there are a whole set of different narratives, one of which has been supply. People have been worrying about the deficit, which is exactly why Secretary Yellen came out and said it's not the deficit. People are worrying about stronger growth. Q3 GDP data was very strong. There's no two ways about it, and so that contributed to it. Other people are worrying about, is there going to be a pullback from risk by global investors? Other people are looking at the Bank of Japan. We just had that meeting, right, where they effectively, de facto, got rid of yield curve control. So it's not just one single thing. It's everything coming together.
So what's your compass at a time where we're expecting the Fed to come out today at 2 in varying shades of we have no idea and we will see just along with you? What is your guiding lodestar?
So we're trying to figure out, along with the Fed, sort of what's going on with the economy. The strong Q3 data notwithstanding, there are some signs of the economy slowing down. The last jobs report, super strong, but if you look at the trend over the past 18 months, clear downward trend. If you look at the GDP data, consumption spending holding in, But a lot of the strength was in inventories. CapEx was, not very strong at all. And so we are seeing that slowing. And so what we think is the Fed's looking at the same data we are. They're driving by feel a little bit, and they're not going to hike today. We don't think they're going to hike in December because inflation just keeps undershooting their own forecast for where they thought inflation was going to be this year.
What does the job dynamic look like with an Ellen Zentner sub 1% Q4 GDP?
Well, I think this is where we want to keep in mind that there's so many swings from one quarter to the next to some of the spending data. Like I said, the inventories numbers, that was never going to be the primary driver.
So she's not giving you gloom on the job economy here.
Not at all. I will say that we have at Morgan Stanley, Ellen and I and the rest of the team have been consistent from the beginning of this hiking cycle to say, the Fed's going to hike, they're going to bring down inflation, but we are not going into recession. It is not doom and gloom.
Well, she's expert on the American consumer. What is Zentner, when she gets fired up, she does. When Zentner gets fired up about the American consumer, what is she saying?
Lots of things, but in particular, one of the key risks that maybe people are overlooking for why there should be a slowdown in the fourth quarter is student loans, right? There was a moratorium on student loans. That's been lifted. We're starting to see that payback starting to happen, and that has to crimp consumer disposable income, so that matters. Durable goods, right? Interest rates are high. Credit card rates are high. People financing cars and other things, it's just costing more, and so they'll pull back on the spending.
Hey, just extraordinary. Seth Carpenter, thank you so much. Really, really appreciate it with Morgan Stanley this morning. Lisa, I got red and green on the screen. I haven't said it all day. We got a nice lift here, and the VIX pops under 18. Bottom.
I mean, basically, what we're looking at is a bond market that's driving all the action. You're seeing a lift to stocks as bond yields drop. We're going to talk about just how significant this refunding announcement really was.
Wait, these
coming
are good
up
guess.
on the open. Yeah, I'm really excited. Bob Michael of JP Morgan in the studio, Tom Porcelli of PGIM Fixed Income, and Kate Moore of BlackRock to parse through how much this has sucked the oxygen out of the room, frankly, for the Federal Reserve.
Lisa Bramwitz, thank you so much. Again, we welcome all of you here, really sparing down. We're going to stay with you on radio and television here through the half hour. We've got a good 20 minutes to go here. And now to shift from the economics of Dr. Carpenter, much more to what we see in fixed income. Ira Jersey joins us. He's Chief U.S. Interest Rate Strategist at Bloomberg Intelligence. Ira, your thoughts on a refunding? Clearly, the equity markets like it.
Yeah, I think people were hedged for maybe even more long-end issuance than the Treasury market delivered. And I heard you just talking to Mr. Carpenter there, talking about, the fact that the Treasury Department kind of is looking for where they can get the best demand for the product that they're selling. And by doing a little bit less in the long end and a little bit more in the front end, you've seen a pretty decent rally as a knee-jerk reaction to this announcement.
It's a knee-jerk reaction, but isn't this just policy prescribed over the decades of saying we're going to be measured, cautious, and when in doubt, stay with short-term paper?
Well, the Treasury Department has what they want to be. They want to be very consistent in how they operate, and they're always going to adjust issuance based on market conditions, based on demand. So keep in mind, like something that Lisa said early on, I have to push back on a little bit. The Treasury Department did increase its long end issuance quite substantially when interest rates were extremely low a few years ago, with the average maturity of the debt of the public going from under 5 years all the way up to over 7 years. That's come down a little bit as they've been increasing a lot of T-bill offerings have obviously come up quite a lot since the debt ceiling was raised back in June. So I think now they're kind of calibrating even again, saying, okay, it's okay if we reduce the average maturity of the portfolio a little bit because there is a demand preference for short paper, like 2-year paper, 3-year paper, when interest rates are above 5% there, and there's decent demand. Whereas in the long end, where there's less demand, we just won't raise as much. But they still raise, right? They still are issuing more long-term debt, at just at a slower pace than they were before.
Should we have a French 50-year bond equivalent, or dare I say, with my losses, Ira Jersey, should we have a 100-year Austrian bond equivalent?
So I was a little bit surprised back when they announced that they were going to do the 20-year, that they didn't also do a 50-year, because I think that the 50-year meets the needs of certain investor types. I think that one of the big fears was twofold for the Treasury Department. One is they didn't think they could do it enough in size that it would really matter, whereas they could do just more 30-year bonds or 10-year bonds and issue more of those. And the second is that they were worried that liquidity would be very poor, because they know that whatever they did sell would probably just be put away at insurance companies and some pension funds, and you'd never see the light of day. So there might be a bit of a liquidity issue with that. So do I think that it could work? Yes, but it has to be structured right.
I've got a recollection, Ira Jersey, of the Tennessee accent of John Templeton. And Sir John would say, I predict there'll be a shortage of bonds. And I would say, through the recent years, there's been a feeling of a shortage of bonds, price up, yield incredibly low. Is there a shortage of bonds right now?
I don't think so, and primarily because there was a shortage of bonds when you had global savings wasn't exceptionally high. And with global savings now being eaten up by inflation and by less workers in the workforce, because even though there's now a shortage of workers, that there probably is. I don't want to say that there's too many bonds outstanding right now, but certainly supply demand is somewhat more imbalanced now than it was. You also now, of course, don't have over the last 20 years central banks in the market at the extreme levels that they were before. Even the Bank of Japan is starting to pull back quite a lot on its bond purchases. So as you get all the supply-demand dynamics shifting, you're going to have probably somewhat structurally higher yields in general, regardless of how many bonds you actually have outstanding.
If you're just joining us on radio, on television, this is wonderful, without commercial, with no commercial interruption here through the half hour. Seth Carpenter of Morgan Stanley joining us now. Ira Jersey with us with Bloomberg Intelligence. Will continue. And coming up, I'm thrilled to say Mark Cabana of the Bank of America will join us here in moments. And I want to shift this, Ira, over to where you live and Mark Cabana lives, which is the inflation-adjusted yield. To me, that's the big difference permeating the system. I walked in today to a 2.50% 10-year inflation yield, really buttressed up against new high inflation-adjusted yields. Let's pull back a little bit. Right now, I got 2.44%. Will that impinge the economy, Ira Jersey, as you look at it from Bloomberg Intelligence?
Well, so yes, in a way it will, right? So we had structurally negative real yields for a long time, and now that real yields are at 2.5%, and maybe even moving up slightly more, although I think that we're probably nearing a peak in yields for now. It will have a slowing effect on the economy, but I think it also gives investors an interesting opportunity here, because you can, like, if you were fearing inflation in 2021, you had to buy real yields. You had to buy tips with a negative yield and coupons that were effectively zero. Now you can actually get a real yield at a reasonable price, where you're going to make 2.5% above inflation for the next decade. And I think that is relatively attractive, given given the potential outcomes, given that inflation is going to be fought by central banks, that the central banks don't want inflation to be extremely high. So I think it could be a win-win, where you win if inflation goes up, and you win if inflation goes down and central banks cut interest rates. You could wind up getting price appreciation from those tip securities, whereas you weren't going to get that back in 2021.
Ira Jersey, thank you so much. The Bloomberg Intelligence is driving all of our fixed income research. I need to do a market check here. It's dynamic, and these are small moves. For Global Wall Street, it may be like a so what market check, but there's just so many narratives going on now. The major one is futures -14, even -15, and we have had a shift in the markets to green on the screen. SPX up 2 points, Dow still red. NASDAQ 100, again, fractionally green, and critically, the VIX from that 2021, dare I say 22 level. We've had a number of days here of quiescent VIX, 17.89 right now. on the volatility index of the Standard & Poor's 500. Yields in, maybe not the drama of 20 minutes ago, 5.05%, the 2-year rather, 5.05%, 10-year yield 4.86%. For a cup of coffee, maybe a sip of Tang, we had the 30-year bond under 5%, 5.02% right now. Some curve dynamics, we'll talk to Priya Misra about that here on the Fed show later this afternoon. 2s10s is rather the real yield has given me some real move from a 2.50 to 2.45. So maybe a less inflation fear out there. Brent crude up $2, $87 a barrel. The dollar story we really looked at 3 hours ago, I'm going to call that stable but a resilient dollar. He writes piercing notes for Bank of America. There's no other way to put it. Head of U.S. rate strategy. He's aged in the last 10 minutes. Mark Cabana joins us this morning. So I'm like refunding. So what? I don't care. Everybody's in a lather. It comes out. And to me, it was sort of, I really don't care. Janet Yellen said, we're going to do short paper. Yeah, we're going to do long paper. But we're the United States. Our listeners, our viewers who are not sophisticated, do they need to fear the fiscal system of America?
No, you shouldn't fear the fiscal system because the U.S. economy is still going to be very robust. There will be buyers for Treasury paper. It's just a matter of at what level will they step in. And we've had a relative lack of buying recently, but that's meant that yields have had to adjust. And as they've adjusted, that should incentivize more investors to think about owning bonds. And we do think that rates are going to keep rising or they're going to stay elevated really until you see one of two things. Number one, until you see the macro data slow. We don't think that you've really seen that yet. Or two, until you see de-risking, until you see investors who think, you know what, rates are kind of high. Real yields, almost at 2.5% at the 10-year point. That's a decent own, and maybe I should think about de-risking in my portfolio.
This is such a valuable conversation that I got to get to what we see on balance sheets right now, mark to market, and the rest of it in bonds. But let's stay on this theme right now of our new higher yield regime. How far out are you in the longer? I mean, if you take any given yield, any given spread, is there a Cabana 1 year? Is it a Cabana 3 years? How do you see the regime of longer?
Well, we just think that rates are going to have to stay higher for longer, not to reiterate the Fed mantra, but we really believe it because we've seen an economy that's been so resilient in the face of relatively elevated interest rates. And as long as that happens, that just is going to mean that the Fed doesn't have to cut for a while. Now, when I think about longer, I personally think about 5 years plus.
Oh, wow. Okay. You got my attention.
Just because, most investors who really focus on liquidity and liquidity management, they think generally 2 years, 3 years. But when I think about intermediate to long end, I think about 5 years plus.
Okay, and I'm going to invent this phrase right now. I haven't seen it anywhere else. I want copyright on this if you use it. Is it normal for longer? Is that really what we're talking about? Is we're back to a normal rate regime?
Well, it's certainly we're back to a regime that looks a lot more similar to the pre-financial crisis than the post-financial crisis.
And you got a 5-year window on that. So what maturity do you buy? I'm in cash. I'm really comfortable at Bank of America. What maturity do you buy given a 5-year normal for longer view?
Well, it really depends upon what your overall investment horizon is and where your preferences are. We think that if you're focused at the front end, you probably want to be neutral to slightly overweight your benchmark. And if you're a more long-term investor, we think that you at best want to be neutral right now. And you want to stay neutral until you see those signs of feedback that tell you that higher interest rates are finally slowing the economy. Not just one data point here or there, but in the tier 1 stuff, in labor, more clearly in inflation. You want to stay neutral until you see those signs or until you believe that there's a clearer and more definitive negative feedback from risk assets, which I don't think that we have really seen sufficiently yet.
I love to bust Brian Moynihan's chops because he like no other CEO quotes his research staff. And I'll go blah, blah, blah about bonds. He goes, well, Cabana says. So let's get the report from Cabana that you would give to Brian Moynihan right now. I got balance sheets nationwide. Mark to market, I get. And I got everything else with massive bond losses, price down, yield up. Should our listeners and viewers be afraid of this non-mark-to-market garbage on balance sheets?
Well, I think you're talking about bank balance sheets, and we do appreciate that Brian reads our research. He's a staunch supporter, and we really do appreciate that. We think that what banks are doing right now is that they are really prizing liquidity. They really want to hold as much liquidity as possible. They're choosing to hold cash. They're keeping reserves with the Fed, and they're not buying bonds, they're not buying treasuries or mortgages, and they're prizing liquidity because they know that they need to meet their outflow needs. They know that their securities book is not particularly liquid because it's so low in value. You don't want to sell and realize the loss. We saw what happened with some of the regional banks.
So what do you do? This is the key.
So what do you do if you're a bank?
What do you do if you're a bank, if you've got all this out there and you don't want to sell, just like you said, but things can happen, things can change. How do you process that reality?
If you're a bank, what you're doing right now is you're holding cash. That is the game. That's why the Fed shrunk their balance sheet through QT by $1 trillion, and you've seen bank cash holdings not move down very much at all. They are bidding up on the liability side of the balance sheet. They're issuing CDs, time deposits, et cetera, to take in more money because they're seeing retail outflows, and then they're holding cash. And they're going to continue to do that until they see signs that the economy is turning, until they know that their loan growth is really slowed down and maybe negative on a year-over-year, 6-month average or whatnot. And they're going to wait until the economy slows more meaningfully to extend out the curve and buy those bonds. Right now, banks are not buying duration. They've been shrinking their treasury and agency holdings, and they're going to wait to add duration until they see definitive signs that the economy has turned. And so again, what banks are doing right now, it's holding that liquidity because that is the most valuable thing that they seem to believe that they can.
What does holding out liquidity mean for mere mortals that can't hold out liquidity? Small business, Torsten Slok at Apollo talks about 10% small business loans as well. I saw 31% charge card the other day. It wasn't Bank of America, of course. 31% charge card interest rate the other day. What does the public do? Given price down, yield up, banks saying, I'm scared stiff, I got to hold cash.
Look, it's a tough time to be a borrower. I think we know that, right? It's a tough time to move. It's a tough time to buy a home. It's a tough time to be a business if you need a loan. And that's exactly what monetary policy is trying to do, right? It's trying to slow down activity by reducing demand for loans and borrowing. And so if you're a small business and you do need a loan, well, you need to think about, okay, what other liquidity sources do I have? Can I draw on any other type of liquidity? And then you got to ask yourself, do I really need to expand? Do I need to make that next investment? And you got to make sure that you can clear a much higher hurdle rate in order to justify those costs. That's how monetary policy works. It should slow down activity through the lending channel. And to some extent, we're seeing that. But it hasn't happened, I think, to the extent that the Fed would like.
Mark Cabana, thank you so much with the Bank of America. Terrific brief here on how we're all being buffeted around by this bond economy, if you will. The 10-year yield, 4.87%. Better equity take, -14 on futures, now +3 on futures, maybe even a high for the day. The VIX, 17.81. On the currency front, I'm going to call it dollar strong stability as well. Let me tell you about the day here. We're going through to November 1 data, including ISM. John Farrow on a cruise ship somewhere. He said he's going to be looking in on that data here. I believe that's at 10 o'clock. We'll see that. On the Fed, we begin strong at 1:30. Priya Misra will join us from JP Morgan. Vice Chairman Clarida, Richard Clarida of PIMCO, Jeff Rosenberg, and Dudley, formerly with the New York Fed. Thanks to our booking team. What a great set of guests. Good morning.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
That's me, Max. What's up? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
City for our viewers worldwide. I'm Lisa Abramowitz in for Jonathan Farrow. A bit of a bid to markets finally after getting some positive news, at least from the bulls on the street from the Treasury Department. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Farrow.
Coming up, futures wavering after closing out the worst October in 3 years. The Treasury announcing plans to boost refunding by less than expected $9 billion, and investors bracing for Chair Powell and another Fed rate decision. We begin with the big issue. Goodbye, October. Hello, November.
The market's been weak.
Equity weakness.
Rising bond yields.
Fixed income volatility in general has been off the charts.
Stocks are in a bit more of a wait-and-see mode.
Investors are looking for any glimmer of hope to start a end-of-year rally.
You've got an opportunity, if events don't erupt in the Middle East, for year-end rally.
This economy will come off the boil.
The big thing is, what's inflation doing, what's economic growth doing, and what's the Fed doing?
No one's expecting the Fed to hike rates this week.
The Fed is going to hold. Whether they actually hike rates again is a question mark.
The market will be more focused on Apple.
We'll get employment this Friday.
The jobs number, is going to be incredibly important.
The labor market is the key right now.
Everybody's trying to figure out what the underlying trend in the labor market is.
Join the confusion. Joining us now to discuss is J.P. Morgan's Bob Michael here in studio, and PGIM's Tom Porcelli. And I'm curious, Bob, from your vantage point, how much are we solidifying on a narrative versus still running around like chickens with our heads cut off?
I think we're pretty close to a narrative right now. Certainly since the end of March, we've seen pretty much a 7th month straight sell-off in the bond market, yields going up very, very high. It seems as though we're reaching a point in the cycle where we're going to establish a range. And maybe the low is somewhere around 430, which was the high from a year ago, last October. And we've seen that 5% brings in buyers. I would say after 7 months of the kind of volatility we've seen, we're due for a range.
All right. So do you agree, Tom? Have we solidified on a narrative?
Yeah, I love that the way you phrase that, as you always do. Yeah, look, I think that it's. I don't know if we totally solidified on a narrative, particularly as it relates to the economic backdrop. I mean, a lot of people I speak to, I think, are still sort of in these two distinct camps. Either you're looking for no recession or you're looking for a recession. In fact, I would say there are fewer people looking for the latter. I think the risk of recession is actually quite elevated. We officially pin it at 25%, which, if you consider the steady state is around 12, you sort of 2x what it would normally be in a steady state backdrop. I think that there are a couple of things that really continue to worry me. I think yesterday's ECI report, just as an example, to me that's sort of an ugly dynamic. Not so much because of what's happening from a wage perspective, because wages continue to slow down, but if you look at companies' abilities to pass on these prices, which are growing incredibly limited, right, relative to if you just look at the CPI as an example. You have a situation where wages, while they're coming down, are still elevated relative to companies' ability to pass on cost. I mean, that tends not to end well from a labor market perspective. And I think there's other data, Lisa, that have been pretty consistent with that. I think the rise in continuing claims, I think, is really pointing to weakness in labor. So I think people will start to sort of gravitate toward this idea, but it's taking a little bit of time economically anyway.
What do you think of that, Bob? I mean, I know that you've been talking about weakness in the market. You are expecting a recession this quarter, in the fourth quarter, rather. That's been pushed out. Where do you see it? Is it really an indicator that other people are seeing as strong?
I think Jay Powell and the Fed have every right to come out today and say, we told you so. We're in a soft landing. We've got full employment and inflation has moderated. If you look at the 3-month and 6-month annualized rate of core PCE, it's 2.5 and 2.8%. We're there. I guess the question is, the trajectory is down. How do you flatten it out from here? And I think that's the big question ahead. But for sure, I would have thought we would have seen more widespread signals of recession, and we haven't.
Well, but hold on a second. And Bob, I'd have to really dig into that a little bit more. If Jay Powell came out today and said, I told you so, everyone's screens would light up. People would say they're overly complacent. They don't understand the risk of reinflation. They don't understand that this underlying strength, as you were talking about, Bob, is going to continue. Why don't you agree with that? Why don't you say, you know what, we are seeing unexpected strength. This does lead to a potential need to keep rates higher for longer.
I said he had every right to, but he's also very, very smart, and that's exactly what he doesn't want. He doesn't want to accidentally ease financial conditions. He needs to buy some time, a couple more quarters, to see the impact of the long and variable lags, and they're there. We've seen the ADP data today. We're seeing some slowdown in the labor market. We're seeing some pressure in the levered loan market. So there are signals that the slowdown will continue. It's trying to engineer that landing that's going to be very challenging for them.
Tom, final thought?
Yeah, I actually agree with what Bob just said. I think the Fed actually probably could come out and say, hey, look, we take a little victory lap. They're not going to, obviously. I mean, I think, because Lisa, you're quite right, too, in that if they did, I think the market would then immediately go to pricing in an outcome that the Fed does not want to see right now. So, look, we get it. I think today at this FOMC meeting, it's really about just sort of pushing the narratives that Powell has put out there, which is to say we've reserved the right to do more, but we want to sort of take a step back for the moment and see how this unfolds.
All right, well, let's get to some of the big news of the morning before getting your comments on that. The Treasury increasing its planned sales of longer-term securities by slightly less than expected. Exactly the news the bond market wanted to hear, and stocks for that matter. Bloomberg's Kaylee Lyons joining us now in Washington with more. Kaylee.
Yeah, Lisa, boosting it by $9 billion to a collective $112 billion, so slightly less than the $114 billion that the market was looking for. And as for what the breakdown is in auctions across the different maturities, $48 billion worth of 3-year notes, $40 billion of 10s, and $24 billion of 30s. The key point here, Lisa, being more of the burden is being put at the short end of the curve. The pace of increases there was the same as the last quarterly refunding back in August, but it's a slower pace of increases in sales of 10 and 30 years, likely a reflection of concern about the surge we have seen in those yields at the longer end of the curve. And some of that, though, is reversing today as a result of this news. We're off of the initial knee-jerk reaction, but still looking at about a 6 basis point decline in both the 10 and 30-year yield. The 30-year yield actually breaking briefly below 5%, now at 5.02, where we're at 4.87 on 10s, 4.89 right now on 3s. And finally, Lisa, as for the picture looking forward beyond this quarter, the Treasury says it likely likely will have one more quarterly bump in its quarterly refunding. So just a single additional increase in the borrowing here as they consider always ongoing the fiscal picture and, of course, what the Federal Reserve is going to do, both in terms of the rates, because that affects the cost of the Treasury borrowing, but also in terms of rolling off that balance sheet.
Thank you so much, Kaylee Lyons in Washington, D.C. Still with us. We have Bob Michael and Tom Porcelli over at PGIM Fixed Income. Tom, what did you make of this announcement and the market's reaction, which was initially, wow, yes, they didn't increase their auction size as much, and then, well, they're still going to be increasing it.
Yeah, I mean, I think there was some relief. I mean, I think the risk was that it could have been worse. It could have been more. So I think that I get it. But I think what the market also needs to get is that, you know, deficits for as far as the eye can see seem pretty reasonable. So even if the Treasury is not going to continue to increase their issuance, issuance is going to remain elevated, I think, for quite some time. I mean, I don't think you necessarily need to sort of, you know, think of it in terms of, hey, you know, there's going to be some big fiscal spend directed toward the consumer or anything along those lines. I think there's bipartisan support generally for defense spending, and you can easily see a scenario, given all that's going on, that really gets, I think, thrusted into the middle of this conversation. And so I think deficits remaining elevated for some time to come remain a very easy argument.
Which, Bob, is the reason why I guess maybe we didn't see as much of a boost to bond prices, yields lower as some are expecting, including Mike Schumacher over at Wells Fargo. From your vantage point, is this telling that we didn't see a bigger pop in price in bonds in response to a positive surprise, at least, from the Treasury Department?
Look, after the last 7 months, we got somewhat of a pop. Think if it had gone the other way, who knows where yields would have been. The Treasury did exactly what you want your Treasury to do. They have a lot of funding to get out of the way for the government. They took feedback from the market. You had people like Josh Frost and Tom Tellis out there listening to the market was telling them, and the market was telling them front-end loaded. There's a ton of money in money market funds. That can absorb supply there. And for us, we're seeing the greatest amount of inflows this year into the front end of the curve, ladders 1 to 5 years out. So we know there's money there to absorb it. The Treasury did a good job. That's calming the market.
So how much, Bob, are you doubling down, buying duration, coming into a market? Do you have confidence to do that despite the sentiment that you were just talking about?
Yeah, when we look at inflation, it continues to moderate across the board. And 5% seems to be a level that brings in an awful lot of investors that are trying to get into bonds and have underallocated to bonds for years. So we do like it here. I'd like to get past the employment number. I'd like to see what the Fed says today, but it looks as though we're going to be in a range for a while.
Tom, how important is that labor report that Bob mentioned coming out on Friday?
Yeah, I mean, look, it's always important, but that's a for better for worse idea, just to be clear. Look, I think, you know, continued moderation in the labor backdrop, even if it's uneven, I think is going to persist. You know, we've been really flagging to people, I think you really need to strip out healthcare from the headline number. Healthcare has been doing a disproportionate share of the driving. And when you do that, what you see is that the job gains have indeed slowed, and slowed pretty considerably. So that's something we expect will continue. And again, I would just flip back to the thing I started off with. It's just watch. You know, the more that you have wages that remain north of companies' abilities to pass on prices, that will not end well from a labor market perspective. That's the real risk.
Although I will push back a little bit on that, Tom. I mean, some of the companies that have come out, whether it's McDonald's, whether it's Caterpillar, whether it's a whole host of others that have shown that both volumes and prices increased, suggest that maybe they are passing it along.
Yeah, so I think you're quite right, Lisa, and you know, we see that pretty clearly in some of the earnings reports. But in the aggregate, that's not the case, right? In the aggregate, you actually are seeing this slowdown persist. Some companies, you know, for idiosyncratic reasons, can certainly be able to pass on those prices. But in the aggregate, we're seeing that that's now fading.
Bob, given this backdrop, is this supportive for corporations, for corporate credit at a time where maybe 5% is where it draws in investors, but it's unclear whether the yield on the 10-year can go that much lower, and financing costs are going to be higher for a longer period of time?
it depends which corporate credit. And I think we've seen plenty that the public markets have the big liquid companies that can access a lot of funding, and they termed out their debt. So the public investment grade and high yield markets aren't what they were in previous cycles. You have to look at the levered loan market, you have to look at the private credit market. Each of those markets is equal in size to the high yield market. That's where you're going to see the pressure. That's where the floating rate nature of those markets is going to create pressure as they refinance at much, much higher rates. You also have to look at banks. You have to look at C&I loans, commercial and industrial loans. A lot of those loans were put on a couple years ago at 5%, and they're rolling over at 10 to 12%. That's a lot of pressure on corporate America that no longer really resides in the public credit markets.
And a lot of people are watching some of those metrics more and more. Bob Michael, Tom Porcelli, so glad to say that both of you are sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
Well, the S&P 500 right now, Lisa, as you've been noting, has turned slightly positive, basically flat. But beneath the surface, lots of big movers, including the shares of CVS, which are down. This as the company did, in fact, beat third quarter estimates, both top and bottom line. But they've tempered their full year view, their strategy of moving more into healthcare, not paying off quite yet, at least relative to profits. Plus, pharmacists are planning a walkout. This stock already down 26% year to date. Estee Lauder plunging down 17%, heading toward what could be the worst day since May. It might even be before that at this point. Their fiscal year sales are now expecting a range of down 2% to up 1%. Disappointing. This on China weakness. Geopolitical risks also weighing on demand for premium beauty. This stock down 48% into today's plunge. And then finally, AMD in the aftermarket yesterday down about 5%. Just moments ago, it had been higher, now down just a little bit. What folks are not liking, their fourth quarter sales view is 5% below the midpoint on weak video game demand. On the other hand, what's recovered the stock to some degree off those 5% lows yesterday, Lisa, is that they've talked about a new AI chip that could be worth $2 billion in net sales next year. This stock up a mere 52% year to date when you compare it to NVIDIA, the AI leader, up about 179% this year.
Abigail, thank you so much. Coming up, counting down to a Fed rate decision.
I don't think it'll be an uninteresting meeting or press conference. It's just really a question of how far Powell wants to go down the road and try and sort of reassure markets.
Trying to justify why to pay attention to a meeting that everyone says is basically a placeholder, a Fed rate decision coming at 2 p.m. Eastern. That's when surprises happen, followed by Chair Powell's news conference. We've got your decision day watch list coming up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
I don't think it'll be an uninteresting meeting or press conference. It's just really a question of how far Powell wants to go down the road and try and sort of reassure markets. To what extent did the Fed really anticipate or understand that their actions at the September meeting was going to lead to this sort of near 100 basis point sell-off in the long end? I mean, it's been quite dramatic, and did they really expect that?
All eyes on the FOMC decision coming at 2 p.m. Eastern. Chair Powell set to speak just 30 minutes later. The Fed expected to hold rates steady. Bloomberg Economics saying officials will likely maintain their tightening bias. So a hawkish pause. Powell is also expected to address the recent surge in longer-term Treasury yields, saying they could, on the margin, substitute for 1 or 2 rate hikes. Bloomberg's Michael McKee joining us now from Washington, D.C. So is this just a placeholder, as Subhadra Rajappa put it yesterday?
Well, if I were to agree with her, the producers of the afternoon shows would all be mad at me. So let me just turn to the Fed Funds futures market and show you just how excited the markets are by this afternoon's meeting. Well, okay, maybe not. No chance at all is forecast basically for any kind of Fed move. How come? Well, one reason it's going to be, as Dominic Consum says, boring, is that there are no dot plots and there is no new economic projections coming out today. The Fed obviously not going to raise rates, but Jay Powell has some splaining to do. Could make the news conference interesting. We've got 4.9% GDP, 3.8% unemployment. We've seen wages rising. How come the Fed isn't going to be moving? Well, here's their argument. The Fed doesn't have to move because the markets did. You can see there the way that the 10-year note yield has risen, and Dominic was talking about that, and that's pulled financial conditions higher. The blue line is the Goldman Sachs Financial Conditions Index. The white line, though, that's the Fed's own financial conditions index. It's only out monthly, but it shows that financial conditions peaked in December and have been getting looser since then. So we'll see if Jay Powell can square that circle. And, of course, it's now time for Bob Michael to tell me what I'm supposed to ask him.
Bob Michael McKee, thank you so much. We do have special coverage of the Fed kicking off at 1:30 p.m. with a whole host of great guests, including former Fed Vice Chair Rich Clarida and former New York Fed President Bill Dudley. So let's get that. Bob, what's your question?
Yeah, Mike, so much to ask today, but I think what you ought to do is go right at the nature of the recovery, which has evolved into a K-shape. Or put differently, the bottom quintile of earners, the younger cohort, they're the ones who have depleted their excess savings. They're the ones who have ramped up their credit card borrowing to try to make ends meet. They're the ones that don't sit on assets that have inflated. And if you look at the top quintile of earners, the older cohort, they're the ones that have all the excess savings. They're the ones that are sitting on houses and securities portfolios that are at elevated levels. What does the Fed think about that, and what are they doing about that? Because if you go back to the Fed Listens Tour of 2019 and 2020, they specifically addressed this and talked about how Fed policy has to be inclusive. And it's evolving into something that is clearly not inclusive.
What about the young people? Tom, what's your question?
Yeah, I was just pondering that question. I ponder it ahead of every meeting. Look, I think, I don't know if it matters what you ask him. I think you tend to get an unsatisfying answer. I mean, I'm sympathetic to Mike and all of the other reporters and journalists down there, because I don't know that he can really. Powell's going to be the last one to say, hey, look, we're changing policy, right? I mean, he's going to stick with his narrative, I think, until the bitter end. And then one day he'll say, okay, we're going to, we're thinking about cutting rates now. So I'm sympathetic to Mike and the rest of the crew down there. Look, I think at the end of the day, I think the challenge for me is I think Powell has, I give him a lot of credit. I think he's done a really good job, particularly over the last couple of meetings, of really sort of sticking with this idea of, look, we really want to sort of take a more wait-and-see approach. You know, let our eyes. I mean, I think that was the exact word that he used during his last speech. You know, let our eyes sort of, you know, judge what's happening with a bit of risk management layered into that. I think that's quite the right response, and so I'm looking for more of that at this meeting.
I love it. That's one thing that Steve Englander said. How many times can you say, we'll see? Bob, is this essentially a meeting that is going to be like watching paint dry, like supposedly the balance sheet rundown that arguably is having a significant impact?
No, and I think you're in the room, you ask the questions, the Fed and their staff can't unhear the questions. So they go back and they work on it and they go out into the market. So I certainly wouldn't pass on the opportunity to ask a question. It's your chance to register issues, so do it, Mike. I don't think this is like paint drying. I think these FOMC meetings, these are like playoff games. We want to see what's going on. We want to be part of them. We want to know what the Fed is thinking. We want to know how they're responding to things. And the markets do move.
That's fantastic. That's a great way to really put forward the Fed decision later. It's like a playoff game. Bob Michael, Tom Porcelli, both of you, thank you so much for fantastic insight ahead of a meeting that is telling. How many times can you say, we'll see? Coming up, the morning calls, and later, BlackRock's Kate Moore expecting stocks to slowly overcome a volatile few months ahead. That conversation still to come.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Let's take a quick look at markets. You are seeing a bit of a churn after better than expected, at least, refunding agreements. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Goldman Sachs adding Boeing to its conviction buy list, pointing to strengthening fundamentals and an attractive buying opportunity. Next up, Loop Capital upgrading Cirrus Logic to buy, expecting upcoming results to benefit from a host of new Apple products. And finally, Barclays upgrading GM to overweight, citing historically cheap valuations. Coming up, we get the word from BlackRock's Kate Moore. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation? Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow, just moments away from the start of trading at a time where you do see bonds controlling everything. Stocks are in the green as we head toward open. S&P futures up 0.2%, about the same as NASDAQ, given the fact that we did get a refunding agreement from the Treasury Department that underwhelmed. The action has been driven by what's outside of stocks. That is what's in bonds. That's in what the bid is to the long end after the Treasury avoided raising some of those auction sizes as much as some people expected. You could see 10-year yields lower off some of the earlier lows, 4.87% rounded up. You could see that being borne out, dollar strength pretty much across the board. This has been throughout the morning, and crude elevated up to 2.4% on the heels of just that ongoing geopolitical and humanitarian disaster. One stock to watch at the open, WeWork, the company reportedly planning to file for bankruptcy as early as next week. This according to the Wall Street Journal. Bloomberg's Abigail Doolittle has more. Abby?
And the stock is absolutely plunging, as you can see, Lisa, down nearly 44%. The worst day in its young life. This company, of course, went public back in 2020. And that's saying something given the the dozens of double-digit down days this year. Into today, the stock already down 99% from that price back in 2020. And of course, today's plunge is spurred by this Wall Street Journal report that the company is preparing to file bankruptcy. In some ways, you could say it's a victim of its own success. They expanded so quickly in the years ahead of their going public. And then, of course, there was the secular shift off of the pandemic, working from home, the less demand for their office space that they were renting, creating fewer flexible tenants. Now, the company missed interest payments back on October 2nd. That kicks off a 30-day grace period. Missing the payment would be considered a default. WeWork declined to comment on what the company called speculation, and yet went on to say that there's a forbearance agreement in those bonds that allows them to have positive conversations to try to work it out. Again, Lisa, this stock down already 99% into this year. It's interesting, though. There's 777 locations across the company. It's going to be very interesting to see how they, of course, do work this out. They're running out of time. Going concern risk is clearly a big one.
Agreed, Abby, especially with all the concerns around real estate. Turning now to the chip sector, AMD falling after delivering a weaker than expected revenue forecast. The CFO saying, quote, "We expect to see strong growth and continued momentum, partially offset by the softening of demand." Bloomberg's Ed Ludlow joining us from San Francisco with more. Ed?
Yeah, good morning, Lisa. The stock is up a full 2.8%, which, believe it or not, is AMD's first back-to-back two-day or multi-day gain in a month. It's completely at odds with the trading that we saw in after hours following the earnings call yesterday, and completely at odds with pre-market trading. The story is the MI300. It is AMD's AI accelerator, akin to NVIDIA's H100 GPU, which is used to train large language models or foundation models. The news is that it will go into production and ship by the end of the year, but the rate at which it will show up as substantive revenue is really what the market's trading on here. Full year 24, Lisa Su, the CEO of AMD, expecting $2 billion of sales for the MI300. The expectation is that in the current period, it could be $400 million worth of sales, and AMD believes this will be its fastest ever product to reach $1 billion in sales. What was disappointing to the market during earnings was the forecast for the current period. The midpoint of the range that they gave, $5.8 to $6.4 billion, was below the consensus forecast. While the street acknowledges, in terms of sell-side notes this morning, that its data center business is in the early innings, it's going to be a while until we see those big numbers from the AI accelerator. The overall data center business is stagnating, and the commentary and guidance we got is that gaming will be a point of weakness. And remember, AMD's origins are in GPUs for gaming. So it's not all perfect, but right now, the stock heading towards a 3% gain, and the market is got what it wants in terms of hearing about this MI300 AI accelerator.
Ed, thank you so much. Turning now to consumers and beauty products, Estee Lauder falling to its lowest level since 2017 after cutting its full-year outlook due to what they said was continuing weakness in Asia. The CEO saying, quote, "We're accelerating and expanding our profit recovery plan to rebuild profitability despite the external pressures on the business." Just how much it is with respect to China. And they also mentioned Israel. Joining us now, Bloomberg's Isabel Lee.
Hi, Lisa. So that's lowest since 2017, you're right, and that's 6 years. And if this current pace holds, the company will be shedding around $7 billion in market cap. So the company cut its annual sales and adjusted EPS forecast, and it's really due to three things. First, it's the pressures in Asia travel business. Second, it's a slower recovery in China. As we all know, we didn't see the pandemic boom that we were hoping, especially in the beauty sector. And lastly is, to your point, the disruption in the Middle East and, of course, in other parts of Israel. So diving into earnings, Estee Lauder expects net sales in a range of a decrease of 2% to an increase of 1% year over year, and earnings of $2.08 to 2.35 cents a share. So overall, a Bernstein analyst said this is an ugly set of numbers, and the Jefferies analyst said they're expecting the stock to re-rate as the recovery timeline is pushed out. And Estee Lauder's quarterly earnings are actually a contrast to its rival like L'Oreal, which saw sales up around 4.5%. And now, Lisa, you see the stock is even really tumbling to more than 18% at this point.
As you speak, Isabel, thank you so much. And sticking with earnings, share of Norwegian Cruise under pressure after slashing its full-year earnings forecast. The CEO saying, quote, "While we're keeping a close eye on rapidly evolving macroeconomic and geopolitical events, we remain encouraged by our strengthening bookings position." Trying to put a sheen on it, Katie Greifeld has more. Katie.
Well, Lisa, Norwegian Cruise has the unlucky distinction of being the first U.S. major cruise operator to lower its guidance this season. Of course, you're actually seeing the shares bounce around. We're going to get to that. But just to go through the numbers here, the cruise line now sees adjusted earnings at 73 cents per share this year. That's down from its prior outlook of 80 cents and below the average analyst estimate of 78 cents. But outside of that, the quarter was actually pretty good. The company beat on earnings. Sales were in line with estimates. And the company also said that demand for trips to Maui is rebounding following the fallout from wildfires in that region. And just for some context, about 6% of its capacity typically stops in Maui in the fourth quarter, so that's good news there. And you can see those different cross currents playing out in the shares right now. Of course, Norwegian fell about 7% pre-market after that outlook cut. Now higher by about 2.5% or so. But zooming out, Norwegian only about 10% higher in 2023. That is lagging Carnival, Royal Caribbean in a big way. And I'll just add, both of those companies actually increased their outlook recently. So Norwegian, the odd man out.
Katie, thank you so much. Hard to come up with those macro stories based on some of the travel names. Stocks coming off their worst October in 3 years, forcing a number of strategists to cut their outlooks. Wall Street's biggest bull, the latest decay of Oppenheimer, slashing its street high target of 4,900 down to 4,400, about where it had been earlier in the year, citing souring sentiment amongst traders just simply running out of time. Ed Yardeni also sounding the alarm, writing, quote, "We still think a Santa Claus rally is possible, but between now and Thanksgiving, Thanksgiving, it's easier to see downside than upside for the stock market given the unsettling developments in the Middle East and jitterness in the bond market. Let's continue the conversation now. I'm so pleased to say with BlackRock's Kate Moore. Do you agree, Kate, that even if the fundamentals paint a picture that could be positive for stocks, sentiment just won't allow it?
Yeah, sentiment is really, really low right now. And actually, I was looking for earnings season to really encourage investors to get back into the market, even if it was more around idiosyncratic stories than broad market exposure. But there's been very little coming out of CEO and CFO mouths that have encouraged the investors to put cash to work. And I think this is because the macro uncertainty is incredibly high. People have no idea, frankly, what 2024 is going to look like from an inflation, from a labor market, geopolitics, political dysfunction standpoint. And so, the commentary has been very soft from management teams, and that has led to downward pressure further on sentiment. So I was hopeful, Lisa, at the start of reporting, we were going to get an increase in enthusiasm, and it's just failed to materialize.
Which raises this question, and the bulls in the street will say that this actually sets you up for a rally. Maybe it's not going to happen in the next month, maybe not in the next 2 months, but at some point, just because things are so depressed that people are looking past any beats, any positive signs within corporate balance sheets.
Yeah, I have to agree with that. And look, sentiment had been deteriorating for a while, and this is kind of another important leg down. But of course, in order for reversal, and even if it's just more technically driven, there has to be some sort of positive catalyst, whether that comes from policy guidance or from the labor market, which I think is going to be a key thing that investors across asset classes are going to be watching, is left to be seen. But I absolutely agree. Whenever you have this level of bearish sentiment and you see all these sell-side strategists cutting their forecasts into year end, that sets up for a bit of a rally. How long-lived that's going to be, I think, is up for debate. And I think you're going to have to be really tactical around trading it over the next 2 months.
Some people would take the bearish side of it. JP Morgan's Marco Kalanovic among them, seeing earnings estimates, quote, divorced from the risks posed by tightening financial conditions and rising geopolitical tensions, writing absent preemptive rate cuts by global central banks, we see risks compounding with peak effect of restrictive monetary policy still ahead. Kate, from that vantage point, right, on one hand, there's a geopolitical overhang. On one hand, there is sort of just general angst and concern. On another level, we have a profoundly different financing conditions, given how high benchmark yields are. And, even based on what we saw this morning, sure, you could get some rallies, but they're not going to be that significant given what people expect from the U.S. economy.
Yeah, I think there are two ways to respond to that view. I mean, the first and most importantly is that there have already been rolling recessions across industries in terms of earnings in the U.S. economy. You saw, bank earnings and healthcare earnings driven by pharma, materials. Now you're getting energy and autos, for example. Semiconductors have been depressed. You've seen this weakness in the U.S. and the global economy as a result of higher policy rates. So just because aggregate economic data hasn't shown that, or aggregate earnings haven't been as bad as in previous earnings recessions, I think we need to recognize that some pain has already been felt and some adjustment has already happened. The second part of it is, of course, there's this huge differential, and I know we've talked about this before, between the large cap and the small cap side in terms of dependency on debt, how expenses and spending are financed. I think it's really important to recognize that for most of us that are large cap or mega cap type investors, there is very little floating rate debt, and most of the spending is being financed from free cash. So it's a very different story at the index level versus at the small business side. And the small business, while being important from the labor market perspective, is not necessarily going to drive the stock market.
So what I'm hearing from you is it that the long end of the Treasury curve is too volatile to even play with, just ignore, go in the front end, clip your 5% coupon, go into big tech, and call it a day?
I would say outside of big tech, there are also some pretty interesting opportunities across cyclicals emerging. I mentioned kind of the rolling industry earnings recessions, and I think there are some interesting values being presented across resources and across more cyclical parts of the economy.
How much within the bond market is that sort of the dominant idea, that there has just been too much volatility, too much uncertainty about what's driving the incredible volatility in the long end to get involved? Is that how you guys feel?
I think volatility in general has been weighing on investors. There's a long expectation that volatility was too low, we were kind of missing something, and now that volatility has moved back up, or at least measured volatility and expected volatility towards levels that are more commensurate with long-term averages, there is a sense that perhaps we need to be more cautious. And again, taken that with the macro uncertainty we've talked about, the softer guidance we've gotten from companies, and the fact that there's a lot of policy decision yet to be made, to not just today, but also through year end. I think you take all this together and people really do want to be more cautious in terms of their risk taking, which presents itself both on the bond side as well as on the equity beta side.
Kate, it strikes me, and I'm kind of thinking through this in real time, so bear with me, that it seems like while the bond market was suppressed completely by 0% rates for however many decades, or at least for more than a decade, that the market structure changed. And suddenly, now that we have yields and volatility, we have leveraged players getting into the treasury market in a way that we hadn't before. How much is that really what's whipping things around at a disproportionate pace?
Yeah. Look, here's what I'll say. I'm less an expert on the technicals within the bond market and the players in different parts of the curve. But one of the things I am very aware of is the calculation that equity investors are making when deciding whether or not to take equity risk. And we haven't had the same type of calculation since before the financial crisis, where, the cash yield is really creating, huge competition for overall equity risk. And now analysts have to say, okay, I like this stock, I think we can move, but can you move, 5.5% plus some, considerable equity risk premium in the holding period in which we're going to own that stock? And so I think the calculation is different. Investors who've gotten very comfortable with one way of analysis over the last 10 to 15 years are having to change their models. And I think that's going to lead to some pretty interesting opportunities next year, albeit more idiosyncratic than just broad market.
So in other words, you think that there are a couple of shoes to drop?
Perhaps. But I'm not bearish, Lisa. I'm not totally bearish.
You're not being bearish.
I'm more cautious. Yeah, I'm more cautious than I've been.
There could be a couple of casualties, maybe, to some of the fragilities that we're talking about. Kate Moore, thank you so much for taking the time. It's always wonderful to speak with you. Coming up, House Republicans struggling to gain support for their Israel aid bill.
Demanding offsets for core national security needs like supporting Israel and defending Ukraine is a break with the normal bipartisan process that could have devastating implications for our safety and for our national security interest overseas.
That conversation coming up next.
Names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
In a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C., it's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, this is a national problem. And, this isn't, random theft. This is organized crime. And, state legislation has put guidelines on, how much the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we are all part of an organization that's coming together that says if you've, we can put our camera feed together and tell that that person has been in our store and their store and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades? I guess?
You know, I will tell you, it started at razor blades because that's such a high ticket item, but you know, it's a lot of cosmetics. But really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think we've been very clear. Saw it in Crane's statement last night, how deeply concerning this House Republican bill is, and how it doesn't meet our national security needs. Demanding offsets for core national security needs like supporting Israel and defending Ukraine is a break with the normal bipartisan process that could have devastating implications for our safety and for our national security interest overseas. There shouldn't be any political games played here with our national security or trying to turn support for Israel's self-defense into some sort of political football.
Secretary of State Antony Blinken returning to Israel Friday, reiterating U.S. support as fighting continues. This as the White House warns Biden could veto the GOP's Israel-only aid bill, which demands IRS funding cuts and excludes aid for Ukraine. The administration saying the bill, quote, fails to meet the urgency of the moment by deepening our divides and severely eroding historical bipartisan support for Israel's security. This bill is bad for Israel, for the Middle East region, and for our own national security. Let's get to our team coverage right now. Bloomberg's Oliver Crook in Tel Aviv and Anne-Marie Hordern in Washington, D.C. Anne-Marie, I want to start with you. Just how contentious is this issue about getting some aid through?
Well, it's very contentious given the fact that we heard from the White House yesterday saying that the president will veto this bill, this standalone Israel bill that House Republicans are looking to pass this week. So it's one, contentious with the White House. In this statement, the White House talked about that they're making an ally as Israel in the world a political pawn in this debate, and that it sets a very dangerous precedent when it comes to wanting to secure partners and allies around the world. That's the first hurdle. The second is the fact that you're actually going to see Mike Johnson, the Speaker of the House, come up against Senate Minority Leader Mitch McConnell, who wants to see a bigger, broader package. So there's going to be not just confrontation between House Republicans in the White House, but also House Republicans and other Republicans in the Senate.
Meanwhile, Oliver, there's a real question about what's going on in terms of the strategy of the Israeli army, about how they are planning to continue what they're doing in Gaza, at the same time that there are some fronts that are getting increasingly active outside of that area. Alia, what's the clarity that we're getting in terms of scale and scope of what's going on the ground?
So let's focus first with outside of Gaza. And, you know, again, there's been continued firing back and forth on the northern border with Lebanon. I think the Syrian side has gotten a little bit more quiet, but that's another one to watch. And, of course, now paying a lot more attention to Yemen and some of the missiles that are going up the Red Sea and some crossing even over Saudi Arabia. So those are the other ones. But again, the main action, the main focus right now is on the ground offensive that is going on within Gaza. There is not a great deal of transparency from the IDF in terms of what their movements are. We understand that the troop movements seem to be encircling Gaza City. And of course, one of the main focuses overnight was the striking of this refugee camp, which killed at least dozens of people. It's not clear how many of those people were part of Hamas. A number of them at least were, says the IDF. But again, this is a densely populated area, and it's not clear how many people had already evacuated. So the pressure is continuing to mount here. And again, we see that the Israelis themselves have also lost, they say, their 11 soldiers since they entered into Gaza over the weekend.
Do we have any sense, Anne-Marie, just quickly here, of who else Tony Blinken plans to meet with in the region aside from Israel?
At the moment, we only know that he's going to Israel. He also is going to be touring the region, as you mentioned, Lisa. They have not released the names. Likely, potentially, you can see him go to Jordan and meet with King Abdullah. The President Biden had a call yesterday with the Jordanians, also potentially President Sisi of Egypt. Egypt is critical at this moment, especially given the fact that Tony Blinken said yesterday up on the Hill that there are about 400 Americans, and including their family, that means about 1,000 that are stuck in Gaza. And we know at this moment, it's not looking like those American nationals are getting out.
Oliver, Anne-Marie, both of you, thank you so much for being with us. Meanwhile, fresh PMI data crossing the terminal. Let's get straight to Michael McKee.
Lisa, you and I have been talking all day about this indicator or that indicator being boring. You want boring. The S&P Global Manufacturing PMI just out. Last month was 50. The forecast was 50, and it comes in at 50. So absolutely no change in the PMI outlook on the S&P side. Now, at the top of the hour, we get ISM, and that's the one that the market really pays attention to. We could have something similar happen because last month was 49, and the forecast is for 49. If we get 49, we'll know there's a manufacturing conspiracy out there. Other thing we'll watch at ISM is the prices paid index, supposed to go up just a little bit. That would not be something that the Fed would look too kindly on, even if it may be still temporary.
Mike, thank you so much. Meanwhile, we do see the rally in 10-year treasuries in particular continue, with yields now down about 10 basis points from the highs earlier overnight. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Watching this week. JOLTS data coming out at the top of the hour, as well as, of course, ISM manufacturing data, and FOMC rate decision coming out at 2 p.m. Eastern, followed by Chair Powell's news conference Thursday. More data, including jobless claims and durable goods, plus Apple reports earnings. We haven't even talked about that today. And we'll get a decision from the Bank of England. And finally, on Friday, the big jobs report, the October non-farm payrolls report, and our special coverage of Fed Decides kicking off at 1:30 p.m. Eastern, speaking with former Fed Vice Chair Rich Clarida, as well as many, many more. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. It is Fed Day. We're going to check in with my former professor, Cam Harvey, at Duke University. He's at the Fuqua School of Business. We'll get his thoughts on this Fed meeting, Treasury refunding, all that kind of stuff. Jen Reed and George Ferguson, both the Bloomberg Intelligence. We're going to talk about this Spirit JetBlue trial starting. They're trying to get this deal done, but all the regulators are in their face. It's actually going to trial, so we'll break it down there.
The stock has dropped from like $22 to $3.
Yeah, I mean, when you go to trial, that's not good to get a deal done. And we're going to check in with Joanna Gallegos. She's co-founder of Bond Blocks. Talk about ETFs. It's a great business she has. ETFs just for fixed income investors. What a great niche she's got there, and we love checking in with her. But first, we're going to kick things off with John Tucker.
All right, thanks, Matt and Paul. We are always data dependent, especially on Fed Day. So let's start off with the JOLTS job openings. 9.5 million job openings in the month of September, according to the survey. That's down from 9.6 the prior month. The prior month also revised lower to 9.5 million job openings. The major stock indexes, they are higher right now ahead of the Fed decision and the news conference this afternoon. Ed Yardeni at Yardeni Research says Treasury yields may be enticing at this point, but stocks still the way to go.
At this point, I think that 5% is awfully attractive, but I think over the long run, we're going to find that this correction is offering opportunities in technology and financials and even in energy.
Right now, the S&P 500 up 18 points, Dow up 84, the NASDAQ 100 83 points higher. The 10-year yield down 12 basis points. That's at 4.80. 2-year, more policy reactive there. That's down 6 basis points, 5.02%. Estee Lauder tumbling after cutting its annual sales and adjusted earnings forecast. And yes, it's finally here, the marriage of AI and fried chicken. Boom. In their earnings report, Yum Brands telling us they're testing a voice-enabled AI-powered drive-through platform at some of the restaurants in California.
Would you like fries with that?
I have no idea what that
that's is. That's the genius of AI. So like normally the teenager or whoever working the drive-through,
hey, Matt,
he's bored, he's high, he forgets. He doesn't
Maybe
ask.
And
what you want is every time if you're the franchise owner, right? You want every person to hear, would you like fries with that? Because you want to upsell them, right? AI is going to be much better at upselling them than the teenager you hire.
No, you're going to want to eliminate teenagers from the process and just have AI run the whole thing. That is the dream of everyone.
No. Exactly.
Every business.
By the way, I've been told I can't show video of from my Ring camera, from my doorbell Ring camera.
Yeah.
We put out, when I took my 3-year-old daughter trick-or-treating for the first time, it was awesome. I loved it.
Good for you.
Obviously, we're leaving the house, so we just left a big bowl of candy outside.
Ooh, not good.
By like a pumpkin and a skeleton and stuff, And most kids came and took 1 or 2 or 3 pieces. Then a couple of teenagers show up in like bunny suits. They like look around and grab the whole bowl.
That's what happens in Westchester.
Just take everything, and they walk away, and then they come back a few minutes later, and they pick up a couple of the things they dropped on the floor.
Wow. Tough times up there in Westchester. Tough kids.
Can I tweet that video, you think, or should I? Yeah, because it's my house.
No. What was your daughter's costume?
She was Moana.
Okay.
Yeah. She's always, like every day, she's Moana, so it worked for Halloween, too.
Was Paul handing out the beers at the
Budweiser in cans? Yeah,
exactly. Oh, yeah, big line at
why all the kids
Paul's
like to go
condo on
there.
the Jersey Shore.
Exactly. John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. Jess Minton joins us here. What's happening in the markets?
By the way, can we start with the Treasury refunding? Because I was glued to the radio this morning.
First of all, let's start with it is open enrollment and that closes on
True.
Friday.
I wanted to tell everybody in the office because I don't think people share this out loud enough. Yes, you get an email. Yes, you get a postcard. But if you're like me, you forget anyway. It's open enrollment.
Right.
Well, they design it for people like you, Matt, because if you do nothing, you forget, everything just rolls over.
Right.
Right, including the FSA.
Everything
don't you have to refund your healthcare accounts and stuff?
So the calendar flipping not only to open enrollment, but what typically is one of the strongest months of the year for the stock market in November.
We're starting off great.
Segueing there.
What do you got first?
Looking at SEAG Go for the S&P 500, you can look at the heat maps. You can go back the last 30 years and you can see November, typically the second best month of the year, behind April for the stock market. Obviously, seasonality has been following a particularly close pattern, especially in recent months, coming off the back of August. And September is typically the worst months of the year. Obviously, October is the most volatile, but people are hoping, because mutual funds do have that October 31st typical deadline for tax harvesting, a little bit different than the individual taxpayer, which is toward the end of December. So typically, also the blackout period for certain companies with buybacks typically rolls off, and more of them can begin that. So some traders hoping that could potentially give a seasonality boon to the broader stock market after a rough 3-month period there for the S&P 500 posting losses. But that's something that I've been watching pretty closely there for the seasonality as far as the calendar flipping to November, Paul.
Absolutely. Hey, talk to us about Estee Lauder. Why
do you not want to? I want to. Okay, you've had Tom explain to you Treasury refunding, but I thought it was going to be.
Had Liz Capo-McCormick.
I thought it was going to be a huge deal, and I see that yields have fallen a little bit, but I don't feel like the Earth has shaken.
It never does.
That was the big thing coming into this week, people talking about how that was going to be the event, as well as Apple's earnings on Thursday overshadowing the Fed decision, because we know most likely what's going to happen. It's more of just obviously what Fed Chair Powell, the man himself, indicates at 2:30 in Washington time, but also
we got an expert coming on in minutes, Matt, that's going to explain it all to you.
We don't have the Fed dot plots or the quarterly projections at this meeting. We got them at the last one, so we'll get the next ones in December. But when we do get the statement, looking at some of the rhetoric changes as far as how that they're going to talk about the particularly recent strong job gains and how that could be characterized. So they might say something that it remains solid rather than saying having slowed in recent months, like it did say in that September statement. And then also when they're talking about some of that recent inflation data slowing down a little bit, talking about how that's above target could be phrasing that they use instead of something like they used elevated in the last statement. So those are some key words there in the statement at 2 o'clock. Usually that's like second, third graph where they have those wordings there. So that's something that traders are focusing in on ahead of what Powell says at 2:30.
Anything else you'd like to ask, Matt?
No, that's it. Thanks.
You got it?
I'm good.
Nobody talks about Estee Lauder stock's down 20%. The Chinese aren't buying.
It's like one of the most read stories on the Bloomberg.
That's why
Actually,
I go there.
yeah, that stock ticker symbol EL. It's on pace for its worst percentage gain on record. If those losses do hold, right now it's down about 20.4% this morning. So when you are looking at that stock, lowest levels since actually 2017 at a certain point this morning. And then also, so this is a cosmetics company. Paul and I were talking about this earlier this morning, but it did cut its annual sales. And then also when you're looking at its adjusted EPS forecast, also cut that there. So it did cite different pressures, especially when you're looking at Asia and in particularly China because of the travel retail business and then a slower than expected recovery overall, just looking at mainland China. So this is a company in particular. And then Paul and I were talking about earlier Canada Goose also. That's another stock that is coming under pressure this morning.
Overpriced.
Really, you weren't a fan of the
No, I didn't buy in.
GOOS on there is the ticker symbol.
All right. Very good, Jess Metton. Thanks so much for joining us. Now, Matt, we're going to get some smart conversation about Treasury refunding, Federal Reserve, all that kind of stuff. We can do that with Campbell Harvey. He's a professor of finance at the Fuqua School of Business at Duke University, my former professor, and I can vouch that I did pass his futures and options class. I can't say I did more than pass, but pass is good enough back in the day. Hey, Cam, thanks so much for joining us here. Matt really wants to get smart on this Treasury refunding today. What are your takeaways from what they announced?
So I think we need to look kind of beyond the refunding that was announced and just in general. So right now, the amount of debt service is about $630 billion a year. And the average interest rate on that is 2.8%. Okay, so we know that rates are like 4.8% or up into the fives with the short term. So it's reasonable to assume that given the needs and given the $2 trillion deficit, that the debt service will explode. Indeed, it will in 2024 be the second largest spending category. Right now, again, it's $230 billion a year, and that will definitely go up to probably 900 over the next year. Just the deficit alone.
$900 billion? That's going to be the interest costs?
Yeah. So right now it's 630.
$1 trillion a year in interest costs? That is insane. Yeah. I mean, exactly. We talk about big numbers, Professor, all the time here, but that's just bonkers. I mean, didn't like Treasury understand what was happening? Why, when we were at zero, why didn't they just put out 100-year bonds like the Austrians?
Well, I advocated that. Take advantage of these super low rates. And obviously, when you do that, the rates go up. But still, it was not normal to have 1% rate on a 10-year Treasury, given what inflation was.
We hit 1% on the 30-year in 2020.
Yeah. So again, you could argue you should take advantage of that. But look, the problem is a structural problem. So when we have reasonably good growth and a $2 trillion deficit, that's a big problem. And again, so the 630 is carefully calculated. So, for example, we need to be careful with the Fed balance sheet and stuff like that, which is kind of left pocket to right pocket for the government. But, if you carefully calculate it, it's about $630 billion, and that's at 2.8%. It's reasonable to expect that rate will go up, and when it goes up, it'll be the second largest spending category, just paying interest. That is not a good situation.
It's not, yep.
And especially if we have slower growth. So we had a great print, and this is kind of consumers running down their savings. And if you look at kind of the leading data, you can see that those savings are pretty well depleted. The consumer is not going to bail out the economy in 2024 like it did in 2023.
Hey, Cam, when we hear from the Fed Chairman Jay Powell this afternoon, he's probably going to come out with the language that, as it relates to inflation, we have a long way to go to defeat inflation. Do you buy that?
No. And we've talked about this before. So if you calculate the inflation rate with kind of real-time prices for housing and rents, the inflation rate is below 2%.
Really?
The only reason it's above 3 is we've got the lagged effect from rental and housing inflation that happened last year. So in real time, we're below 2%. I have no idea what they're talking about. And making policy based upon data from last year, that doesn't make any sense. You make policy based upon data today and what you anticipate will happen in the future.
Isn't it frustrating to watch this happen? I mean, if you advocated for, you know, longer term debt when we were at zero interest rate policy, I can't imagine who would push back against that. Why would the Treasury Secretary not do that? And then if you think the Fed is using, you know, clearly bad data in order to drive policy, that should, I imagine, annoy you too. Like, is it difficult to move around in this world?
Yeah, I think annoying is the right word. This is not rocket science. You just look at the data. It's very clear what's happening, especially with the housing inflation. So the housing inflation, if you believe the CPI, is running at a rate over 7% year over year. And that just doesn't square with the data. It doesn't square with year-over-year rents. It doesn't square with year-over-year housing prices. It's because it's reflecting what happened last year. So I think that there is a problem. We need to use data that is real-time data. Housing inflation is not over 7%, and that is the reason most of the print that we get, the prints that have been over 3%, is being driven by stale data on housing. And that just doesn't seem right. And also, we've seen the long rates increase pretty dramatically. And this is kind of flattening the yield curve, but in a very bad way. So usually what happens before kind of recessions, that you get a yield curve inversion where the long rates are below the short rates. But then it becomes normal. And usually what happens is that the short rates decrease to cause the normal yield curve. That's not what we're seeing. We're seeing the long rates go up. That's very bad. That increases the cost of capital. And that serves to slow the economy. So this is not a good situation in any dimension. And don't be fooled by that GDP print.
Yep. So is the risk here, Professor, that the Fed is overdoing it and will in fact push us into recession?
GDP will fall off a cliff, plus our interest payments.
So the Fed should have stood down in January of this year. So I agree that they've made things worse. And it's especially bad given what we've seen happen to the long-term rate. That ripples through. And just think of, you know, these firms with commercial real estate loans and things like that, where that market is already cratered, and what's going to happen. So we saw kind of a mini banking crisis in March, and then it's hush hush. Well, I'd like to see what's going to happen in the next few months, because we're not going to have 4+ GDP growth. that consumer spending has been depleted. Savings have been drawn down. And on the investment side, we've already seen that decrease in 2023. So I do believe that the Fed has overdone it unnecessarily, shot themselves in the foot and the economy at the same time.
All right, Cam, thanks so much for joining us. A bunch of us, class of 91, we're coming down to Fuqua next weekend, so watch out. Cam Harvey, professor of finance, the Fuqua School of Business at Duke University. I can vouch. He has no basketball game, but he's a genius on the world of finance and economics and all that kind of stuff. This is Bloomberg. Let's get some company news right now with Mateo.
You got it, Paul. WeWork having its worst day since it went public back in 2020. Now, it comes after a report from the Wall Street Journal that the company plans to file for bankruptcy as early as next week. We have more from Bloomberg's Abigail Doolittle.
Now, the company missed interest payments back on October 2nd. That kicks off a 30-day grace period. Missing the payment would be considered a default. WeWork declined to comment on what the company called speculation, and yet went on to say that there's a forbearance agreement in those bonds that allows them to have positive conversations to try to work it out.
Shares really plummeting. They're down right now more than 51%. CVS Health's cost-cutting strategy, well, that's paying off as it expands its healthcare business. The drugstore chain posted higher sales and profit in the third quarter and reaffirmed its full-year adjusted profit outlook. Bloomberg's Steve Rappaport has that report.
Lisa, CVS topped estimates as the drugstore chain cuts costs and dives deeper into the healthcare business. Adjusted earnings came to $2.21 a share, up 4 cents from a year ago. Rhode Island-based CVS has struggled with rising costs in its pharmacy and insurance businesses. The company warned investors in August that those issues will take a toll on profits over the next 2 years. CVS eliminated 5,000 non-customer-facing positions to streamline operations and reduce expenses.
Now, at the same time, CVS and its rival Walgreens are facing walkouts and protests from its workforce. More than 2,000 pharmacists plan to walk off the job this week to pressure the drugstore chains to address poor working conditions. Pharmacists say they're frustrated with staffing levels. Shares right now down about 2%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Ahead of the Fed rate decision and news conference this afternoon, the major stock averages, right now they are higher, with data this morning showing job openings unexpectedly climbing for a second month. So this underscores the persistent strength of labor demand. The Treasury does plan to slow the pace of increase in its quarterly long-term debt sales. As a result of that, yields dropping across the curve. Right now, the 10-year 13 basis points lower, 479. The 2 years down 7 basis points, 5.01%. The S&P 500 up 23 points. That's up 0.6%, 4217 on the index. The Dow Jones, the Dow Jones Industrial Average up 135 points. The Nasdaq 100 up 104 points. That's up 0.75%. Microsoft, the leader in the S&P 500, up 1.7%. And Estee Lauder, the laggard in the index, that's down 20%. Worth mentioning here that, real quick, Huey Lewis is headed to Broadway with a jukebox musical.
Nice.
The Heart of Rock and Roll will play the James Earl Jones Theater starting March. Significant to me because I thought Huey Lewis was dead, but apparently he is not. So this is good news
Huey
for
Lewis,
all of us.
I was just about to say,
as
he's
Hugh
dead.
Gregg III. It was a class of 1967 at the Lawrenceville School, along with Michael Eisner, former CEO of Disney.
Who is from Red Bank, New Jersey originally.
And went to Denison.
And went to Denison. There you go. It all comes together. So Hugh
Mike
Lewis,
Eisner told me a great story about his grandparents' house on Broad Street in Red Bank. It had this tower, and he used to go up there, and he told me he would over the side when he was a little kid. I don't know why he admitted to that, but there you go.
Very good. All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. All right, Spirit, JetBlue, they're trying to merge. We're going to get to that in just a second because Bloomberg Markets is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Outstanding direction right there. Jen Reed joins us here. George Ferguson joins us via the Princeton office, the camera there. Why we have Jen Reed and George Ferguson here together? They're from Bloomberg Intelligence because we're going to talk about Spirit and JetBlue. Those airlines are trying to merge or one buy the other. Matt doesn't believe in mergers. One is buying the other.
Obviously, JetBlue is trying to buy Spirit.
But the Department of Justice is saying, whoa.
Yeah.
George, he follows the airlines for Bloomberg Intelligence. Jen follows all the antitrust stuff for Bloomberg Intelligence. Jen, let's start with you.
Sure.
Why can't we let these two little itty-bitty airlines get together? I mean, it's not United and Delta here.
You know, it is exactly the way you look at it. So this is what JetBlue says. We're two little itty-bitty airlines, right? Nationally, we're tiny, maybe 8% combined share, but from an antitrust perspective, that isn't how you look at it. When you look at the way antitrust might impact a consumer, you look at it from a consumer's viewpoint. So when you're looking at it, you don't look at airlines nationally, you look at them city to city. You look at routes that consumers buy to travel, right? And if you reduce the options in a route from, let's say, New York to Los Angeles, a consumer can't choose some different route because the prices went up. So you're looking route to route, much more narrowly. And in route to route, this is a different kind of merger than the way you'd look at it nationally.
Hey, George, how important is this merger for either of these companies if it doesn't happen?
I don't know, right? I guess we'll see, right? Because right now, both these companies are losing money. So clearly, I think the fares that Jen's concerned about, they aren't enough to support even profitability. And I think that the JetBlue CEO is going to have to figure out soon how bad he really wants Spirit Airlines because he's going to have to raise $3.5–4 billion to buy it at interest rates that are probably going to be above 8%. And again, in a marketplace, it looks like it has too much capacity. And fares can't support profitability.
Hang on, I assumed that JetBlue had that money stashed aside already. Aren't they? No,
I don't see it. I don't see it stashed in the balance sheet.
Okay.
No.
The other thing
I go find it.
They may not need it, George.
The other thing I wonder about is, you know, JetBlue yesterday, George said there's basically a dearth of travelers, or said differently in the airline industry, there are way too many empty seats in the domestic U.S. But then somebody tweeted at me the TSA checkpoint travel numbers, and it looks pretty healthy to me. I mean, we're last week we had 2.3 million. The week before that, 2.5 million. Much better than we had in 2022 or 2021 or 2020. It's basically up there with 2019.
So I would say you can't always judge airline health by numbers, right? So in the new world of airline revenue management, Load factors we're seeing 85, 90%, right? These are really high load factors. Those revenue managers, they don't let an airplane go down the runway without it being almost full. The secret, though, is you got to get people to pay the price that's going to cover the cost at the airline. And what we're seeing right now in the marketplace is that the low end is that, that consumer that may not be as well heeled, they're seeing softness and their fares are going down. We saw yields at JetBlue fall 13% since the year prior, right? So that's not a healthy environment.
So, Jen, when does this trial start? You're going to go to this trial, right? You're going to attend this trial.
Yes.
Where is it? When is it? And what do you expect?
So it's in Boston. It started yesterday.
Okay.
I've reviewed that transcript from yesterday, which was mostly opening statements. I'm heading out today. I'll be there the rest of this week and next week. It will go to December 5th, non-consecutive days. I think we'll probably get a decision in January. The judge said he may try to do something by the end of December, but that was when the trial was supposed to start in early October. So I think January is more likely. And I just have to, one comment about what George said. I mean, this judge is concerned actually about the health of the airlines, which is unusual in an antitrust case. He has asked not about JetBlue, but actually about Spirit. Can Spirit survive if this merger doesn't go through? And, we're just getting in, but we'll see what the documents look like with respect to Spirit's growth plans.
Well, I was just looking, George's comment, I went to the FA function for both Spirit Airlines and JetBlue. Neither company is making money. To what extent historically do the courts think about that kind of stuff?
Well, there's a history here. So we've had a lot of consolidation in the airlines, and there's a lot of concern about that from the DOJ, and they're going to be using that to their benefit in trial. But we've also had a lot of bankruptcies, right? And bankruptcies aren't good for consumers either. And the judge is going to be looking at that and thinking about that. But the bottom line is the most difficult part about this trial for Spirit and JetBlue is that they themselves, Spirit, have argued that this is an anti-competitive deal when they preferred Frontier as a buyer, and there was a fight. Okay. So these documents have already been admitted by the judge against the objections of the lawyers, and they're going to have to explain those away.
Hey, George, if the judge put you on the stand as an expert witness, Wall Street analyst, would you testify that if these guys don't merge, neither of them's going to make it or one of them's not going to make it? What would your forecast be?
I guess I would testify that the market clearly appears to be overcapacitized, if that's a word, too much capacity, and that it needs some rationalization, and putting these two together could rationalize that and would improve their potential to create profits. So I would argue that.
And I will say that the DOJ opened an investigation of the airlines just for saying exactly that, because rationalization in the antitrust world is a bad thing. It means let's reduce demand to increase prices, and antitrust doesn't want that.
Right. So can't they just say, all right, on a couple of these routes where we're going to overlap or we'd have too much pricing power, we'll just divest these routes? Can't we do that?
That's exactly what they're trying to do, and you know what? The judge might accept that. This is just the beginning of trial. It's not a done deal. The judge might say these divestitures are good enough. You go ahead and merge. That's the healthier option. The issue is the DOJ is also concerned about routes where they do not overlap, because they believe JetBlue's fares are higher than Spirit's fares in those routes, and it'll take out that lower cost option.
I mean, none of this is low cost compared to what I experienced living in Germany for the past 6 years.
Yeah, you can fly to point for like $90.
Yes, and somehow that just keeps going. That's been happening for at least a decade, right? Low-cost airlines in Europe. I don't know that the industry, it would be good for the industry to have that here. Probably not, but can we get that?
So you're asking me that?
Yes, George.
I mean, look, I think you can. I think that when we look at a lot of analysis of these ultra low-cost carriers and the low-cost carriers and even the full-service carriers, when you take all that ancillary costs that they unbundle and try to put back on top of you when you get to the airport and check your bags, blah, 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 the fares aren't a lot different than full-service carriers. And so I think the whole thing is, it's sometimes it seems a little bit bait and switch-ish, right? Because you sign up for like a $50 or $70 fare, and next thing you know, there's all these added costs. And so I think that we can have the industry because they are getting fares that, again, are probably as good as some of the big full-service carriers. What I will say, though, there's an extraordinary challenge, I think, in the U.S., and that is that we just gave away some really large pay increases to the pilots. And what you didn't see under that pilot headline was that everyone else got pay increases too. The flight attendants are looking for theirs. But line maintenance, all those folks have gotten increases. That's going to drive up the average cost of fares, right? And when you drive up the price of something, less needs to be consumed, right? Because you just can't offer as much. So that's one of the major challenges in the U.S. market right now.
All right, George, thanks so much for joining us. George Ferguson covers the airlines for Bloomberg Intelligence, and Jen Rees, senior legal analyst, covering the antitrust for Bloomberg Intelligence. Right now, let's head down to Washington, D.C. Amy Morris has got World and National News.
Thank you, Paul. Secretary of State Antony Blinken is set to head back to Israel after dozens were reported killed and wounded at a Gaza refugee camp. Bloomberg Government Congress reporter Jonathan Tamari tells us it is not clear what Blinken will be able to accomplish.
The situation is obviously primarily in the hands of Israel right now and in the hands of the other countries there in the Middle East that are watching the war unfold in Gaza. What he's hoping to do, I believe, is to try to prevent the fighting in Gaza from spilling over into additional countries.
Bloomberg Government Congress reporter Jonathan Tamari on Bloomberg Daybreak. President Biden will meet with Chinese leader Xi Jinping on the sidelines of the Asia-Pacific Economic Cooperation Summit in San Francisco next month. Bloomberg's Nancy Lyons with an update.
White House Press Secretary Karine Jean-Pierre says President Biden is looking forward to their discussions.
This is intense competition, right, that we have said that we want to move forward with China. We understand that. And intense competition means intense diplomacy. That's what you're going to see.
Jean-Pierre did not go into specifics about the topics that will be part of those conversations. The two sides apparently agreed in principle to a meeting after a U.S. visit by the Chinese foreign minister. In Washington, Nancy Lyons, Bloomberg Radio.
The head of Homeland Security is calling on Congress to reauthorize and expand the agency's counter-drone authorities. Secretary Alejandro Mayorkas says they need the authority to go after the cartel's drones, which are used to avoid Border Patrol.
It's common sense, bipartisan, and critical to our national security. This is not a moment to let our country's guard down.
Secretary Mayorkas says the use of drones by criminal cartels has become a rising source of concern for law enforcement and national security agencies. Human smugglers are also using the drones for surveillance. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom. It is Bloomberg Business Flash. Green on the screen. Stocks edging higher ahead of the Fed decision this afternoon. S&P 500 has topped the 4,200 level. Yields dropping across the curve. The benchmark 10-year rate down 15 basis points, 478. Ella Hoja of Newton Investments says, it's going to be the Fed meeting that will be in the driver's seat for markets for the rest of the day.
The Fed in itself is probably more of a risk factor, certainly on the language. If they use language that acknowledges that nominal growth has been higher than they would have liked, and that even if we come down, we're coming down from very high levels, that potentially has more probability of disrupting rates further.
Right now, the S&P 500, 30 points higher. That's up 0.75%. 42.24 on the index. The Dow Jones Industrial Average up 184 points. NASDAQ 100, 142 points higher. That is up a full percent right now. Shares of Yum Brands 1% higher. They reported third quarter revenue and comparable sales at Pizza Hut. That narrowly missed, but their Taco Bell performance earned praise from analysts. And I don't see any mention of Ozempic. This gives the phrase hair of the dog some new meaning.
No idea what you're talking about.
There are efforts underway to turn dog hair into a hyper-sustainable fabric. Commercial weavers actually in Italy say the hair from some breeds is better than fine cashmere. Apparently the worst dog hair from which to make a sweater is the good old golden retriever.
Yeah?
And the Lopso Opso, I don't know if I'm pronouncing that correctly, is the best kind of hair. They're actually, they're making clothing and stuff from this.
Yeah, no, I've seen people make sweaters from dog hair before.
And I'm surprised you don't have an expertise in this field.
You know what? I do find it interesting.
Okay.
I really do. When you said hair of the dog that bit you, I thought you were going to talk about the vicious cycle of the new Magnolia weed-laced cupcakes.
Of course you would.
Did you see that story?
Of course you would.
It's like the chicken and the egg, right? You have the munchies, so you eat the cupcakes, so you have the munchies, so you eat the cupcakes, so you have the munchies, so you eat the cupcakes.
So a company like Yum Brands would benefit from someone like you?
Oh, yeah.
Taco Bell run?
Why me? Why do you say me?
Oh, I mean, people, well, whatever.
John Tucker, thank you so much. We appreciate that. Let's talk about fixed income, folks. The only place, all right, let's just rewind a little bit. 2022, maybe the worst year ever for fixed income across the board. No place to hide. Not that much better this year, with the sole exception of high yield. So I want to talk fixed income. And when we do that, we talk to Joanna Gallegos. She's co-founder of Bond Blocks. Joanna, thanks so much for joining us here in our Bloomberg studio. Why is high yield actually putting out positive performance this year when every other part of fixed income is once again negative?
That has to do with yield. It has to do with the category that broadly has been yielding about 9% this year. Nice. And if you go down the credit spectrum a bit, even CCC, that's been yielding in the category 14%. So what you get, if you remember your total return, is that yield is insulating and cushioning any of the volatility in down markets. So it's been a great place to find return, and I think there's a lot of surprising facts about fixed income that are starting to come to light.
Well, to me, it's just too tight. The spreads are too tight to take that risk. Looking at 450 basis points, basically, for high yield, I would want more over treasuries. Because I can get, a decent double Bs are 300, Bs are 470, I feel like it's just not enough, especially if you have a very pessimistic view of the economy.
Yeah, so I would probably challenge you a bit on even in high yield. I would agree with you on IG that the spread over treasuries is really, really tight, and you should actually be in places where you're getting compensated for that risk, and high yield is the place that we think that exists right now. The conundrum, or the sort of the confounding thing that people are probably not appreciating, is that this isn't the same high yield from other downturns, if we've even had a downturn in any sense, because these companies have entered this pressure, this economic pressure, with totally refinanced debt. Yep. And there aren't any maturities coming up in 2024 and 2025 that are significant. Their fundamentals are really interesting. So here's a cool story from this week. Ford was upgraded from the BB high yield category into the BBB IG category. And so we really have been calling people's attention to our XBB product, because over 15% of that category and within that product are rising stars, and that's when somebody's fundamentals are improving, and you get upgraded. So there's a lot of hidden quality, that isn't necessarily associated with high yield a lot, within the category. We think that these interest rates have started to profile all these categories a lot better.
All right, so at Bond Blocks, you guys ETF focusing exclusively on fixed income space. Where are you seeing fund flows in your funds these days?
Yeah, so we see a couple different trends. We are seeing some pickup in our high yield suite, especially in the ratings products. So in the high yield suite, you can trade, as I just mentioned, in XBB, which is sort of the first rung down from investment grade all the way down to triple C. I think there's some notion about this relative value, even within the last month in triple Cs, there's a bit of a sell-off, and spreads have widened a bit. But at the same time, there's value in that space and maybe picking up a bit of a dip there. We know rates are higher for longer, and so a lot of people have been attracted to the shorter end of the Treasury curve and investing in our 6-month and 1-year products, X-half and X1. But we really are encouraging people, even the higher for longer doesn't mean you should just sit and get paid to wait, and that should be your only trade. It should be a lot more intentional and look out the spectrum, because to your point, Matt, there's risk out there that you're being rewarded for, and the fundamentals are very different. We haven't seen the deterioration that everyone's expecting. The resiliency continues. Companies are improving. Different sectors are out there, like energy. So we're trying to focus clients on spread, on credit, on ways that they can find intentional, specific opportunities in fixed income.
By the way, you have had exceptional timing, haven't you? I mean, creating these products, packaging them up in ETFs right at a time when demand for the package is amazing, and then demand for bond investment has taken off, even if it's been a tough year, Paul. I mean, remember we kicked off 2023 saying time to back up the truck, and flows have shown the same thing, right? Investors want these products.
Yeah, I think so too. And I think even treasuries, there's been a lot of volatility in treasuries in this year, and there've been a ton of activity in ETF treasury products. Just in the last 3 months, people have experienced tons of losses there, but there's still the port of call that people use to move around their expectations. And I think even in the 10 to 20-year treasury right now, we're seeing people come back into these products either because they want to harvest the losses that they had in the last 3 months. They still want the exposure. So there's a lot of expression that's going on in fixed income ETFs, and that's something we see every day.
What do you think we're going to hear from Fed Chairman Powell here today?
I think we're in a higher for longer environment regardless of what we hear today. A consensus is that we wouldn't see a rate hike today.
Yep.
And if we did, it's hard to say, like, the bad news is the good news, which is the rates are going to continue to be higher for longer. It's some of our new normal. But the truth is that, again, these yields and these relative value across fixed income we haven't had in over 15 years. And so people have to just get used to interacting with their portfolio a little bit better and de-risking it in a way with fixed income that they haven't had the opportunity to do for a long time.
I can't imagine how higher for longer works if we go into a recession and we have no more fiscal firepower, right? I mean, we're deficit spending our way into a hole, essentially. Monetary policy is going to be the only savior.
Well, true, and that's why, to your point about having more ability to act tactically in these environments is really, really important.
Oh, totally agree on the products.
And I think, like, in terms, not just the products, but just for investors in general, like being more attuned to these different factors. And today, I think the investing public has a lot more choice than they did to insulate, respond, think about how they're positioned. Because it's just, it's been month over month, week over week of different types of volatility events, or, but the resiliency hasn't gone away, and like that's the confounding thing, is it hasn't gone away yet.
I feel like the Bond Blocks products really democratize fixed income investing for a whole group of people who otherwise would have been left to pay someone else to do it. I mean, they really bring fees down. And
Hey, Joanna, thanks so much for joining us. Really appreciate it. As always, Joanna Gallegos, co-founder of Bond Blocks, coming into our live into our Bloomberg Interactive Broker Studio. We appreciate that. Looking at the markets here, a little bit of a lift here to the markets. S&P up about 0.7%. NASDAQ up about 0.9%. Yields coming in sharply. The 10-year Treasury off 14 basis points, 4.799 on your 10-year Treasury. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. The first major U.S. cruise operator has lowered its guidance this season. Norwegian Cruise cut its adjusted earnings per share forecast for the full year. Bloomberg's Katie Greifeld says outside of that, the quarter was actually pretty good.
The company beat on earnings, sales were in line with estimates, and the company also said that demand for trips to Maui is rebounding following the fallout from wildfires in that region. And just for some context, about 6% of its capacity typically stops in Maui in the fourth quarter, so that's good news.
Well, it's not helping investors' shares right now. They are down about 2%. Estee Lauder falling to its lowest level since 2017 after the beauty brand lowered its full-year outlook. Bloomberg's Isabel Lee says it's due to three things.
First, it's the pressures in Asia travel business. Second, it's a slower recovery in China. As we all know, we didn't see the pandemic boom that we were hoping, especially in the beauty sector. And lastly is the disruption in the Middle East and, of course, in other parts of Israel. So diving into earnings, Estee Lauder expects net sales in a range of a decrease of 2% to an increase of 1% year over year, and earnings of $2.08 to 2.35 cents a share.
Now, the company says a cybersecurity incident back in July also took a toll on first quarter earnings. Right now, shares of Estee Lauder, they're down about 17%. And Dockers, the brand known for its men's khakis, is seeing success with women. Its new female CEO has been on a mission to grow this side of the business, which is actually up more than 60% year to date. Now, today, Dockers will go live with a blog post focused on, quote, the women who shop at Dockers, the brand owned by Levi Strauss, and shares of that right now down about 2.5%. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets, nice little rally here ahead of the Fed decision coming at 2 p.m. Wall Street time. The S&P 500 up about 0.7%. The Nasdaq up about 0.9%. Yields come in noticeably here. The 10-year Treasury yield is down 13 basis points. We're now at 4.79%. Remember, we were just over 5% recently. The 2 years hanging right at 5% as we speak. The 30-year under 5%, 4.96%. WTI crude oil up about 2.5%, now at about $83 per barrel. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
Thank you, Paul. Some foreigners and wounded Palestinians have been allowed to leave Gaza for the first time since Israel started the ground invasion. Footage on Egypt's Extra News showed the group arrived in the country. We talked about it with Bloomberg's Galit Altstein in Tel Aviv.
Hamas did say earlier that it expects some foreigners and dual nationals to be allowed into Egypt, including Red Cross workers and nationals from Australia, Austria, Jordan, and Indonesia.
Bloomberg's Galit Altstein says 80 wounded Palestinians are being transported for treatment in Egypt. Secretary of State Antony Blinken is set to head back to Israel after dozens were reported killed and wounded at a Gaza refugee camp, stoking concerns about the mounting toll from weeks of fighting. Bloomberg Government Congress reporter Jonathan Tamari says there is an underlying concern about how this war could escalate.
This has been the fear in America since really the start of this conflict, that it won't just be limited to Israel invading Gaza, but that Hezbollah from Lebanon could become involved, that Iran could become involved, that other countries might feel pressure to come to the aid of the Palestinians.
Bloomberg Government Congress reporter Jonathan Tamari on Bloomberg Daybreak. And with Thanksgiving just 3 weeks away, some new details about what your turkey dinner might cost you. Wells Fargo reports while inflation has started to slow, this year's dinner will not be any more affordable. Dr. Michael Swanson is Wells Fargo Agri-Food Institute's chief agricultural economist.
Things are going to be a little bit more expensive this year than last year. So turkey's kind of the exception to the rule this year, that it's actually cheaper than a year ago.
Dr. Swanson says turkey prices are down 13%, but ham is up 5% and canned cranberries up a whopping 60%. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Matt.
All right, Amy Morris, thank you so much. We appreciate it. Coming up in the next hour, we're going to check in with Tim Dewey, Chief U.S. Economist at SGH. Macro Advisors, get his thoughts on this Federal Reserve and on this Treasury. We're trying to refund our debt here. Matt, you mentioned earlier this morning, something got my attention, weed cupcakes?
Yeah, I'll bet that got your attention, buddy.
Yes.
So there's a story in Forbes magazine, or Forbes.com, that Magnolia Bakery is going to introduce new cannabis-infused desserts. So they have a line of cannabis edibles that they're working to create in partnership with a company called Incredibles, which is owned by Green Thumb Industries. That's a publicly traded company, Green Thumb Industries. The ticker here in the U.S. is GTBIF. It's like an ADR, I think, because it's Canadian listed. But anyway, Green Thumb Industries and Magnolia are going to make banana pudding cupcakes and red velvet cupcakes.
Now we're talking. Yep.
Hell yeah. That have some kind of weed in them. I was looking to see if they listed the strain. I mean, are we talking about
Have we
Durban
just
poison here?
abandoned all hope for the future here? That's what I feel like.
Well, I don't,
It's
you know,
the new
to
world.
me, it kind of makes sense, except for the fact that my main
None of this
concern
makes sense.
with weed is that you just want to eat more after. And then if you eat more, you can fall into a vicious cycle.
But then you get Ozempic.
But you know what? There's a store on, I think it's like 25th and Broadway. They sell milkshakes that are laced with booze.
Really?
So I don't think that's that different, right? Except for you can die from booze and it's terribly addictive. And that's not the case with weed.
It's not the case with weed?
No.
No. Okay, very good. Good to know. All right, so weed, cupcakes.
From Magnolia's, but not in New York, unfortunately.
Why not?
They're going to be making them for their stores in some place in the middle of nowhere, like Illinois or something. We're not going to get them here in the capital of the world.
Good morning to our friends in Illinois.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up, we're going to break down some what seem to be weaker than expected ISM manufacturing data. We'll break that down, get into the details there, and not looking good. Plus, we'll check in with Tim Day, Chief U.S. Economist at SGH Macro Advisors, get his Fed and economic call. Mona Mahajan, Senior Investment Strategist at Edward Jones, is going to join us as well in studio to talk about these markets. What is she doing here to finish out this year and get ready for 2024? But first, let's go to John Tucker and get a Bloomberg Business Flash.
All right, Matt and Paul, stocks rising, Treasury yields, they are plunging across the curve. Investors parsing through a variety of fresh economic data. And the one that's driving treasuries, at least, I'll point to the Treasury refunding coming in less than what had been anticipated. You're looking at the 30-year yield, 13 basis points lower, below 5, 496 right now. The 10s down 12, 480, and the 2-year, 8 basis points lower. That's right at 5%. 10 of the 11 major industry groups in the S&P 500, they were higher. While a rate hold is expected from Federal Reserve policymakers today, Lara Rame at FS Investments says Fed Chair Jerome Powell still pretty much has his work cut out for him.
He really still wants to wash market expectations of rate cuts out of 2024, and the market still has about 50 basis points of rate cuts priced in for next year. So I think they're really pushing hard against that today.
All right, right now the Dow is up 196 points. S&P 500 30 points higher, up 0.75%. 42.24 on the index. The Nasdaq 100 up 137 points. That is up close to 1%. WeWork is preparing to file for bankruptcy as soon as next week. That's according to people with knowledge of the matter. And more than 2,000 pharmacists planning to walk off the job this week to pressure drugstore chains CVS and Walgreens to address what they say are poor working conditions. Pharmacists say they're frustrated with the staffing levels there. And if you visited one of these stores lately, the pharmacy department, you'll know what they're talking about.
Yes.
It's
overwhelmed.
I try to do it by man. Not that I have a lot of pharmacies,
Pharmaceutical needs?
as do some other people in the
Better
room.
living through chemistry.
But no, you do it through, if you mail order it, that's so much easier.
I wonder what the problem is, because there's CVS by me just constantly has a long line.
Well, think about it. I mean,
and the
everybody
pharmacist
has 4, 5, 6, 7 things when a generation ago you had like 1.
Yeah, but if you have a business that's growing, don't you hire people?
I don't know.
I mean, isn't there a school that produces pharmacists? And if you have a problem hiring people, don't you just raise the offer and then they come? I mean,
the big thing is you need people to my prescription's sitting right there. Can you take it out of that bin and give it to me, and I'll give you my credit card?
I'm sorry, stand in line, sir.
I just need that.
I'm sorry, stand in line, sir.
So you're advocating self-serve pharmacies now?
No, exactly. We need some help there.
Every time someone complains about, there's not enough workers out there, but maybe if you pay them more than $15 or $17 an hour, they'll come, right?
Yep, exactly right. John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so check us out there. ISM data here. The measure of U.S. factory activity stumbled to a 3-month low as sagging orders and scant production growth undercut hopes that manufacturing is turning the corner after an extended retreat. Let's break down some of this ISM data. Tim Fiore, chairman of the Institute for Supply Management, that is the ISM business survey. He joins us here. Tim, another tough month for ISM manufacturing data. What'd you see?
Yeah, good morning, gentlemen. Yes, you're right. I mean, there's good news in here and there's not so good news. So let's talk about the good news. The good news is employment's down. We're actually contracting. And if you dig into the comments, it's primarily through the use of layoffs rather than attrition and freezes, which is a much more drastic but a much quicker way of getting your headcount down. So I think what it's really saying is that, coupled with the fact that production was flat at a 50, means that, okay, our revenues are flat. We've got more headcount here than we need for flat revenues. It's time to release some of these people because we got to do our best to maintain profitability going into 2024. So I think that's the good news. The not so good news, I think, is that our new order level was off much more than I expected that it would be. And that, coupled with the fact that the customer inventory level is about right, and the backlog continues to contract strongly, really says, where is demand? Where is the demand? Now, I thought in October, with prices dropping somewhat, lead times dropping somewhat, it would bring buyers and sellers back to the table. It clearly didn't happen in the month of October. So if you look into the industry sectors that did that, primarily, it was computers and electronics, it was machinery, and fabricated metal products. The last one is a big capital intensive area, as well as automotive. So, okay, not big surprise. They were down in the low 40s, high 30s in terms of new orders. Computers and machinery, same thing. So it's kind of isolated to about 30% of manufacturing GDP, but they're pretty significant players here. So when those guys drop, it brings the whole number down. So, we'll see if this is a partial timing thing, whether we kind of come back in November, set the stage for buyers and sellers to agree, more new orders flow, hopefully revenue, i.e. production, stays at that 49 to 52 level, and we're off and running into 2024. But it was a bit disappointing here to see the new order level come down like it did.
Is there some kind of cliff that you can see, Tim? I mean, is there some kind of loaded spring that's going to be released? I mean, there's such dire concerns about the economy. After a 5% Q3 print, it seems strange that we would drop to zero, but a lot of people are saying that. I mean, Stan Druckenmiller is positively terrified just loading into the 2-year.
Yeah, I know. Well, remember, we're kind of ahead of everything. That's why you guys like to look at the manufacturing PMI, because it precedes the overall economy. So yeah, we did 4 and some change GDP in Q3, where at the same time manufacturing was clearly in a recession. We're 12 months into a contracting environment. If you look over the last 20 years, we've had about 6 contraction periods. The longest was the Great Recession, 18 months. But that was fundamental, it was structural, a lot of repair work had to occur before you could allow supply and demand to kind of take off again. But the other 4 or 5 averaged 5 to 6 months. We're twice that now. So, here we go again. The whole pandemic led to a huge shutdown that we had never seen before, then a huge reopening, and then a huge over-ordering, and now we're trying to get off of that. So this pandemic thing is still not done in terms of economic design, and we're struggling through it. I mean, I thought that this would be a pretty good month, but it wasn't. So, but again, it's not a bad month. I mean, the manufacturing inventory number is low. There could be some hangover from Q3 there. Okay, fine. That will come back. Supplier delivery numbers should be getting up above 50 if there's enough tension in the system. That should happen before the year's over. The revenue, like I said, revenue being 50 and some change is good. It means that we're flat to the prior month, which is good. We're not seeing revenues decline, because when revenues decline, you got to really hit the button that says, okay, eject.
Yep.
So we'll see what November brings.
All right, Tim, thanks so much for joining us. We'll touch base with you next month. Tim Fiore, he's the chairman of the Institute for Supply Management, otherwise known as ISM, bringing us some of that economic data from the manufacturing front. Let's get right back to kind of the story of the day, and that is interest rates, the Federal Reserve, the U.S. Treasury refunding that balance sheet, all that good stuff. Tim Dewey joins us, chief U.S. economist from SGH Macro Advisors. Tim, thanks so much for taking the time here to join us here. What do you expect to hear from our Federal Reserve this afternoon?
I think the Fed's going to sound very much like we've seen in recent comments, particularly in Chairman Powell's speech. Basically, they think that they might have to raise rates again, but they're more and more confident they're near the peak of the cycle.
So I'll ask you the same question I was just asking Tim Fiore. Do you see some kind of cliff here that we're about to fall off? Is there some way that we go into recession, in Q4, Q1, Q2 from 5% Q3?
I would be surprised. The reality is, the economy and the GDP almost certainly has to slow from the third quarter pace. I mean, it was probably doesn't really represent the true underlying pace of the economy. However, there's not really a lot of signs out there that the economy is about to roll over hard, that we're about to walk off a cliff. And so I'm still skeptical we're going to see that certainly in the fourth quarter because we're already in it. But before the second half of next year. So trying to pin down the exact timing of a recession is really a very, very difficult.
Well, but there seemed to be, look, Druckenmiller was on stage with Paul Tudor Jones last week. I mean, that's an all-star conference already, right? He says he started to get really nervous. He said he has massive bullish positions in 2-year notes, leveraged. So he says there's too much risk in the world. And Bill Ackman's saying a similar thing. Bill Gross was saying something similar. So these big, albeit old names, are worried about something. What is it?
Well, I honestly don't know why the enhanced fear. I mean, there's good reason to think that you're near peak yields, and so putting aside any worry about the broader economy, we are at a point where the Fed is close to being done hiking. And the more it looks like that's going to happen, traditionally, long yields eventually fall after that point. So from a strategic perspective, thinking about this as a peak is certainly not crazy at all. As far as the warning signs, remember a year ago in October, everyone thought the chance of recession in the U.S. economy over the next year was 100%, and that obviously did not work out that way. So the world has changed. The world is different. It is in some sense riskier. Is it any riskier than it was, during the Cuban Missile Crisis? I don't know about that.
So it's interesting, Tim. We just had Cam Harvey on, finance professor at the Fuqua School of Business at Duke. He was really bearish here. He thinks the Fed has gone way, way too far, and he thinks inflation, if you really look at current data, not historical data, inflation's already below 2%. How do you respond to that?
Well, so I didn't see the interview. If you look at the recent core PCE numbers, it's not below 2% yet. So I think depending what you use as your inflation metric, you probably can find one that's below 2%.
He was taking out housing. He was taking out rent and home ownership, I think.
So you can strip it down and get to something that's slow. And this is a feature of the policy, right? Is that the Fed intended to raise interest rates until we got interest rates above inflation. They're above inflation. They're waiting for evidence to slow the economy to slow. They are seeing that evidence, which is why we've been paused since July here. I will likely remain paused. So yeah, has the Fed reached its peak? Have they gone too far? I don't know, because one of the counteracting issues here is we've had plenty of fiscal policy to help counteract some of the monetary tightening.
So, I guess the question is, if it's higher for longer, how much longer do you think?
So funny thing, usually people will say the Fed's going to cut roughly 6 months after the the last rate hike. The last rate hike could have been in July, which means by the time of the December meeting, if they don't hike in December, they'll have gone 5 months without a rate hike. So the sort of traditional metric would put you at January in a sense. I don't think that that's likely. I don't think they're ready to cut in July. I think the economy will show enough strength that they don't. I do think that they are determined to be very confident that inflation is on track to 2% before they cut. Really, what we need to see is a little bit more weakness in the real economy data.
What are you watching for? Where are you going to see that weakness? Employment, for example?
So that's a great question. If you started to see job growth really running below 100,000 every month, I think that would be a key signal. I think that
Which we're not expecting, by the way, on Friday. I mean, I'm just looking at.
No, we're not expecting that on Friday yet. It's just not. It's not in the cards. If you look at say the JOLTS report this morning, where hiring was basically at pre-pandemic levels, right? And quits rate was basically at pre-pandemic levels. Openings was still arguably a little elevated, but not that much different than trend. And the Fed's looking at it saying this is a labor market that's more imbalanced, right? You need to see something really trip up investment spending, trip up hiring, and those are the things that generally are precursors to recession. You need to get firms much, much more pessimistic on the outlook than we're seeing right now. So again, where I'd see that is in the jobs numbers, in the initial claims data. I'd expect to see it more in durable goods orders than we've seen so far.
Are you surprised by this labor market, Tim? I sure am. We got such a shock to the system, and people are concerned about the economy, even though we had that good 3Q GDP that Matt was mentioning. But it just seems like this market is just incredibly strong. I'm not really sure why.
You know, it's a bunch of factors. I think people estimated just the underlying strength or the momentum that the economy received from the fiscal stimulus and the easy monetary policy. I think that just had bigger legs from the pandemic era policy than people anticipated. It just took longer to work some of that through the economy. I think the other thing that's out there is that nobody really expected fiscal policy to be such a driving force this late in the cycle. And we've seen deficits expand. And I think that's been a real factor that people discounted last year and is really starting to show up this year. And also, I think fundamentally people underestimate the resilience of the U.S. economy. We talk a lot more about recessions than we actually have recessions.
All right, Tim, thanks so much for joining us. As always, appreciate getting your thoughts. Tim Dewey, Chief U.S. Economist for SGH Macro Advisors. Again, we've got the Fed coming up at 2 p.m. with their statement, 2 p.m. Wall Street time, 2:30 will be the press conference. Bloomberg Surveillance, the team will join you at 1:30 p.m. We'll do a little simulcast there, radio and TV, getting you ready for that Fed decision at 2 p.m.
I mean, we know what the decision's going to be, so.
But let's have I want Tom and Lisa to break it down for us.
They will, yeah, a special event.
Yep, Pharaoh's on some cruise somewhere, I'm guessing.
And Mike McKee's questions,
Mike
always a stumper.
Always a stumper, Mike McKee. He flies down to D.C. as opposed to taking the Acela, which is my recommended way to get down from New York to D.C.
Is that some sort of indicator as to whether or not rates will rise?
Oh, that's a good question. I don't know.
Like the briefcase?
I don't know. I think he had a bad experience once on the Acela, so he's just not doing it. But yet he takes the Acela to Boston. So go riddle me that. I mean, instead, I fly to Boston. But anyway.
It doesn't make any sense.
Makes no sense. S&P 500 up 0.5%. NASDAQ up 0.8%. And looking at those yields, 10-year Treasury off 13 basis points, 4.80 on your 10-year. 2-year, 5.01. This is Bloomberg. Let's go to Lisa Matei right now for some company news.
Thanks, Paul. Caesars Entertainment posted third quarter results that topped Wall Street forecasts. What it can't report, the damage from hackers. Bloomberg's Kimberly Adams has that story.
Caesars Entertainment says hackers assessed its customer loyalty program database earlier this year, and the costs of that incident cannot yet be determined. The company said in a filing Tuesday that it has become the subject of multiple lawsuits regarding the incident, and Caesars is looking to consolidate the cases.
Shares right now, they're up about 3%. A weaker yen and improving supply chains are helping Toyota boost its profits. We have more from Bloomberg's Steve Potisk.
After global sales reached a record in the first half of its fiscal year, Toyota is now raising its profit forecast by 50%. But the world's biggest car maker is also lowering its EV sales goal for the year, even as it steps up EV efforts, revealing another $8 billion investment in a plant in North Carolina that will make batteries for fully electric and plug-in hybrid models.
Toyota up about 5%. And slowing EV sales have been taking a toll on Tesla shares, wiping out nearly 1/5 of their value in less than 2 weeks. Now, that retreat in its stock price has erased about $130 billion from the company's valuation. Checking with Tesla shares, they're down about 1%. And AutoNation has launched a website where customers can buy auto parts and accessories shipped right to their homes. The auto retailer says the genuine parts are guaranteed to fit and will be available for more than 25 brands to meet the growing demand from do-it-yourself mechanics. That new website, AutoNationParts.com. Shares of AutoNation right now up just a fraction. Those are the company stories we're following. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Green on the screen. The Fed poised to hold the interest rate steady at a 22-year high for a second meeting. Also leaving open the possibility of another hike, at least that's the expectation. Meantime, Treasury plans to slow the pace of the increase in its quarterly long-term debt sales. Yields, they are plunging. Let's start with the long bond 30-year yield, 13 basis points lower, 496. The 10-year down 12 basis points, 480 there. And the 2-year, 7 basis points lower at 5.01%. That is lifting the risk assets right now. As we say, stocks are higher. Technology shares leading the NASDAQ and S&P 500 higher. Microsoft, NVIDIA, Amazon, all the leaders there. S&P 500 up just about 20 points. That's a rise of 0.5%, above 4,200, 42.13 on the index. The Dow Jones Industrial Average of 134 points, and the NASDAQ 100, 95 points higher. That is up 0.7% right now. And Estee Lauder shares, they are plunging. That's the real standout today, down 18%. The beauty giant slashing its full-year outlook. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube, so check it out at youtube.com. Search Bloomberg Radio. Just looking at the S&P 500 little graph, I mean, we just were ripping it from the beginning of the year through July. Everybody was a champ, and then it's been tough sledding, off about 9% since that July high here. We're getting a little bit of a bump here the last couple of days. What do we do from here? With the Federal Reserve, presumably, and I guess we'll hear more definitively today, higher for longer. So we welcome somebody who does this stuff for a living. Mona Mahajan, Senior Investment Strategist at Edward Jones. She joins us live here in our Bloomberg Interactive Brokers studio. So, Mona, what are you telling the good folks at Edward Jones here about these markets? I mean, I might just take, my money and just go buy a 2-year Treasury and just say, to heck with you guys.
Yeah, thanks so much. And it is a question we actually get quite a bit from clients. 5% plus yields, pretty attractive relative to really any time in recent history. So we'd say more broadly to that one is, yes, we think part of your investment portfolio, especially the part that should be in cash-like instruments, can be in these attractive 5% plus money market CDs. But keep in mind, there are a few risks if you're too overweight cash. Number one, of course, there's reinvestment risk. So we do know Fed's on hold for now, but at some point over the next 12 to 18 months, they will start pivoting lower. So those CDs you buy now could reinvest at lower rates going forward. Number two, there's an opportunity cost.
By the way, you don't need a CD, right? Because you're getting more than 5% on a 20-year bond.
Just get
and there's like very little reinvestment risk for Paul on a 20-year bond.
The reinvestment risk part of it, if you go long-term bonds, Paul, anyone else in that space will get less reinvestment risk. Accurate there. The other risks are opportunity costs. We already seen an S&P 500 was up a 15-16% earlier, still up a good 7-8% year to date, so above that 5%. And then the third reason, probably for a long-term investor like Paul and others, over time, any 30-year period in history, we've seen cash underperform both equities and other bond markets as well. So it has been a lagging asset class broadly.
We had a decade of ZERP in there, so
any 30-year period. Yeah, I do think, like we said, part of your portfolio does make a lot of sense. And if you think about it, people talking about 60-40, 70-30, even 80-20 portfolios, they're going to start to look much more favorable in the next 10 to 15 years. You have not only an environment where Treasury yields are elevated, we don't think they're falling back, exactly to your point. We're not going back to zero bound in the Fed funds rate, probably not going back to the 1.5 to 2.5% 10-year Treasury environment, probably hovering somewhere in the 3 to 5% range longer term. And so in that environment, in equities, growth and maybe growth and value makes sense. And in bonds, they're a more meaningful part of your portfolio, source of income and potential return. So very interesting next 5 to 10-year environment, we think.
But the worry is the next 5 to 10 months, or maybe the next 10 to 15 months, because some very big investors are concerned about this economy. We were just talking about Stan Druckenmiller, and I'm sure you saw his comments with Paul Tudor Jones, but Ackman and Gross are saying the same thing and going long bonds right now. There's a list of worries out there. The rates are one thing, but then you've got consumers starting to put everything on credit cards. Delinquencies on those payments include and auto loans, right? If you have to refinance anything right now, it's a hard hit to take. And the federal government is strung out. They can't do anything, but if they do something, it's going to be spending money we don't have, right? So.
Yeah, no, all great points. I think you might have been listening in on our investment committee meetings, but I certainly think the 4.9% GDP growth we saw last week and for the third quarter may have been a near-term peak in this economy for this cycle at least. And so we do think, exactly to your point, there's pressures building on the consumer. So not only the rising credit card debt, rising delinquencies, we know they're tapped out in excess savings, and by the way, they're still looking at 8% plus mortgages and an interest rate environment that's elevated. Bank lending standards remain tight. So we do think headwinds building on the consumer, maybe some early signs of labor market easing, and all of that will lead to economic growth that we think falls to probably not some deeper prolonged recessionary environment, but to below trend. And so that 2% growth we saw the first couple of quarters, 4% plus growth third quarter, probably falls somewhere between 0 and 1% in the next, call it 2 to 3 quarters. So softening growth ahead of us. But, as we reemerge from that period, looking into 2024, we could still be in this environment where inflation could be moderating, rates could be peaking, and as we talked about, maybe pivoting lower. And by the way, earnings growth, which we think will be flattish this year, nothing to write home about, could start to reaccelerate next year. So not a bad environment if you're looking at 12 to 18 months. But if you look in the near term, we do think that softening is still ahead of us, and something everyone's been waiting for and maybe even anticipating at this point.
We're about halfway through, I guess, the earnings cycle here this time around. I guess, we're seeing, like we typically do, a lot of, beating expectations kinds of things. But it seems like the commentary has been cautious.
Yeah.
A lot of caution in the commentary and the forward guidance and things like that. What are you seeing so far in this earnings cycle?
Yeah, no, it's a good point. And look, I don't think companies and corporations are getting rewarded for really having very optimistic fourth quarter guidance. And so we do see, yes, to your point, we're looking at third quarter that was supposed to be kind of flattish and modestly positive to up 1% to 2%. So there is a decent beat rate occurring already. But when you look at fourth quarter, revisions have started moving lower. And so we're looking at something like 4% to 5% for fourth quarter versus what was a 7% to 8% expectation. And that will lead to, calendar year 23 growing probably somewhere between 0 and 1% year-on-year S&P 500 earnings growth. So, we still are seeing parts of the market that are growth-oriented leading those earnings expectations. Last year, we had a huge year in energy, so this year they're kind of paying the price, and the comps have gotten a lot tougher. Big negative growth coming out of the energy sector. But generally speaking, we are seeing a corporate environment that has remained resilient. Probably maybe one of the reasons why we're still not seeing a lot of widening in credit spreads. There's not this urgency or concern that there's a huge default cycle coming on the horizon. Corporations generally have adapted pretty well to these higher rates and pressures on margins. And hopefully next year, given the lower comps they'll be facing from a flat year this year, we'll start to see that reacceleration continue or reemerge.
That I find so fascinating, that you don't see a huge spread for triple Bs, for high yield. It just, I guess they all refied when it was zero. And even though the Treasury didn't do a great job of that, companies did.
Yeah, I think part of it, you're right, is that they locked in these lower rates for longer on their own balance sheets. Part of it is the sectors that they are exposed to, areas like, energy and healthcare are generally more stable in terms of corporations and corporate balance sheets, default rates, et cetera. But interestingly, we would say probably some caution around high yield in particular as we look in the months ahead, especially as we talked about if we're facing this environment where economic growth may be slowing, probably some widening is ahead of us. Or if we had to pick the next leg higher or lower, we'd probably go with higher here. So some caution there, but interestingly enough, it's on our radar for potential for opportunity. So we're hoping that we do get a little bit of widening so we can start thinking more seriously about high yields.
How much do you think the Fed is going to have to cut in the next 12 to 24 months?
Yeah, it's a good question. Look, they've told us they want to do 50. Originally, they told us 100 basis points, so they moved that back to 50 basis points. We do think if we head into an environment where we get a cooling in economic growth but no recession, look, they're at 5.25% to 5.5% now, and inflation is now falling well below that. So, even core inflation and headline inflation, closer to 3.7%. Do they need to be this restrictive if inflation continues to moderate? So we do think sometime in the first half of next year, they'll start to signal rate cuts. They've told us also that their neutral is somewhere around 2.5 to maybe, between 2.5 to 3%. So we think what they'll do is market it as a gradual move towards a more neutral Fed funds rate. And maybe they'll do 50 to 75, depending on the economic environment next year, and another 100 basis points in probably 2025.
Okay.
So,
well, just some headline on the labor front just crossing here. Schwab lays off 2,154 people out of a total of 35,900 staff as it moves to cut costs. So it's about a 5% cut, and it just feels that's a meaningful number to me.
That's so painful.
That's a meaningful number. So we'll have to see that. We'll see. Obviously, the jobless claims, the non-farm payroll on Friday will be big, as that always is. Mona Mahajan, she's a senior investment strategist at Edward Jones. We appreciate getting a few minutes of her time here in a Bloomberg Interactive Brokers studio as we kind of await the Fed coming out with its statement at 2 p.m. Wall Street time. We will have complete coverage, of course. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us.
All right, thank you, Paul. Some foreigners and wounded Palestinians were allowed to leave Gaza for the first time since Israel started its ground invasion. Meanwhile, a refugee camp in northern Gaza reported to have been struck a second time in less than 24 hours. We get more with Bloomberg's Oliver Crook in Tel Aviv.
The main focus right now is on the ground offensive that is going on within Gaza. There is not a great deal of transparency from the IDF in terms of what their movements are. We understand that the troop movements seem to be encircling Gaza City, and of course, one of the main focuses overnight was the striking of this refugee camp.
Bloomberg's Oliver Crook reporting there. The head of Homeland Security calling on Congress to reauthorize and expand the agency's counter-drone authorities, which expire next month. Secretary Alejandro Mayorkas says they need the authority to go after the cartel's drones, which are used to smuggle in drugs and avoid border patrol.
It's common sense, bipartisan, and critical to our national security. This is not a moment to let our country's guard down.
Secretary Mayorkas says criminal cartels use those drones for surveillance and to smuggle drugs and people. One of former President Trump's children is expected to testify today in his New York civil fraud trial. Donald Trump Jr. will testify in the case where he's being sued for allegedly inflating his assets in financial statements and has denied all wrongdoing. Eric Trump is expected to testify tomorrow. Ivanka in about a week. Trump himself will testify on Monday. One person is dead and another is trapped after a coal preparation plant collapse in Kentucky. The structure is more than 10 stories tall. The workers were inside on the ground floor, dismantling the structure, which had not been used in several years. Kentucky Governor Beshear has declared a state of emergency in Martin County, Kentucky. That is where the rescue effort continues. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
Connection lost.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Treasury yields have plunged, and the major stock averages, they are higher right now. You have 7 of the 11 major industry groups in the S&P 500 up. Bloomberg Economics says the Fed likely to maintain its tightening bias today after some of the recent economic activity is surprised to the upside. A Fed decision and news conference this afternoon. Of course, we're going to bring it to you live here on Bloomberg Radio and TV. Dominic Constant at Mizuho Securities says the Fed is facing a conundrum as it wraps up its two-day meeting.
The consumer, who's got great balance sheets, has decided that even as they spent all their fiscal excess that they were given after COVID, they're deciding to leverage up, even with interest rates as high as they are. But they can do that because of the balance sheet. So that kind of delays the impact of this super restrictiveness.
With the S&P 500 22 points higher, that's up 0.5%, 42.16 on the index. The Dow's up 127 points. The Nasdaq 100 up 102 points. That is up 0.7%. And according to the Traders Almanac, November traditionally kicks off the best 6 months of the year for the S&P 500. Then you have this contrarian indicator from Bank of America. It puts together Wall Street strategists a recommended allocation to stocks posting its biggest drop in a year, so that brings the gauge closer to flashing a buy signal on risk assets. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Boy, some more layoff news. Panera laying off 17% of corporate staff as it eyes an IPO, and that's according to the Wall Street Journal. So just more anecdotal labor front news there. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio, and we're also streaming live on YouTube, so check us out there. Simple question. Can stocks work in this higher interest rate environment? That's all I'm asking. David Kudla, maybe he's got an answer. He's a founder, CEO, and CIO of Mainstay Capital Management. So, David, we've had the market pull off almost 10% as since that July high. Rates started moving higher. Begs the question for a simple equity guy like me: can I make money in stocks with rates at this level?
Good morning. Yes, I think we can still make money in stocks. We've got a lot of mixed data out there. And you mentioned some of it on the show about what's happening with the consumer taking on more debt to continue to buy. And we need the consumer to hold for the economy and stock market to do well. But, we've had through the end of last week, 10% sell-off from late July. We had those 3 negative months for the S&P 500, down 11% for the NASDAQ. And I think we have the start of a rally here this week. And, when we look at all that data, we have concerns, but if I'm looking at where I want to be positioned right now for the 10% sell-off, I'm constructive on stocks through year end.
So after that drop, you think it's better to move some of your money from the 2-year Treasury back into stocks? I mean, Paul's already got his entire net worth. Sure. Sitting in I have de-risked the T-bill ETF. What do you think? I mean, does it look more attractive to you than the 5% you get there?
It looks more attractive. And think about the 60-40 portfolio, right? If the 40% of that portfolio were in the long bond and intermediate term bonds, where everyone over the past months was buying duration, you've been hurt pretty bad. If you've stayed in ultra short-term bonds, like Paul has, you've done pretty well, up 4, 5, 6% this year. And we think that stocks going forward, if we stay with large cap profitable tech, other companies that are profitable in this environment, we're going to have about a 2.5%, 2.3% earnings growth in this quarter. So we've gone through that earnings recession. We're now headed back up, probably another 5 or 6% earnings growth in the fourth quarter. Barring a recession And, what we've said, we call it the recession that's always 6 months away. And I know there's people out there like Stan Druckenmiller and Bill Ackman and Bill Gross that are more concerned about that. They're in the 2-year because they're looking for capital appreciation, not the current yield. So I think that's yet to be seen. But with the labor market this strong, coming off 4.9% in GDP growth, there's positives that are outweighing the negatives, and how does that net out over the coming months is really the key. Because we know the Fed will leave the door open to raise rates, as I like to say. There'll be another hawkish pause today by the same name as my garage band that will keep playing.
Good stuff. All right, so if we're getting more constructive on stocks here into the year end, do I just dive into what's kind of been the good play over the last decade plus, which is technology?
I think so. I think that should be, it's an overweight in our portfolios. I think that's where you want an overweight because, as rates do come down, all of our growth-oriented storage, especially technology stocks, they're long duration stocks. And so they'll benefit as rates come down. They've done well this year as rates have gone up, but we know what happened in 2022. And then there's some areas we can look at as well that also have opportunity. And it's really about, avoid, small caps for now. These higher interest rates affect small caps more than large caps because they depend on debt and for refinancing. If you look at the Magnificent Seven or these giant mega cap stocks, they're funding their expenses with free cash flow. So for those reasons, we want to stay away from smaller cap issues. We want to stay with large cap and mega cap. And we are on for our income portfolio, even shorter than Paul. We're all the way down at the ultra short-term bonds and in several areas there that, are up 5, 6, 7% this year.
In terms of, I wonder what you think about ETFs, because you mentioned cash flow, and I think about so many people over the last few weeks saying, like, that's what they want. And then I think of cows, obviously. Right. Yeah, that's the ETF that targets companies with high cash flow. What do you think about that? What do you think about ETFs in general, David?
I think ETFs, are a great vehicle. There's a lot of active ETFs coming to market now that are going to be coming to market over the next year. And, it's a good way, as tactical asset allocators, we use ETFs and ETNs a lot. I'd be a little bit more concerned with bonds. I think one of the errors in ETFs in the bond area is they provide daily liquidity in a market that really doesn't always have that kind of liquidity. So you have portfolio managers out there that are using ETFs for the income portion of the portfolio so that they can exit quickly, and then that sends some real ripples for the rest of the shareholders. I'd be careful in the bond space with ETFs. In stocks, it's a great way to play a sector in a diversified manner or an index.
David, Matt's a much younger man than me, so he's worried about the deficits. He's worried about the Treasury issuance, rising, interest rates rising.
Are you not worried about that, Paul?
In my lifetime, forget about it. So are you worried about it, David?
About interest rates rising?
And just the deficits and...
We were talking with Cam Harvey earlier from Duke, and he was saying that interest rate servicing costs are going to be almost $1 trillion a year in the very near term future. That seems insane to me.
It is insane. Now more than what we spend on the military. And the thing is there used to be this school of thought that at some point the service on the national debt grows to the point that where you have no room for discretionary spending, all you can do is fund the entitlement programs. But what have we learned? Our government doesn't care about deficits. They don't care about debt. They just keep spending the money. So that's why, if you look, just the numbers that are coming out now about new debt that has to.
Hey, David, we're going to have to leave it there just because of time, and we'll get back to you as we like to do. David Kudla, founder of Mainstay Capital Management. get some company news right now. Lisa Mateo.
Thanks, Paul. Chipmaker AMD gave a revenue forecast weaker than expected, but shares are higher. Now, it's the company's first back-to-back two-day multi-gain in a month. Bloomberg's Ed Ludlow explains why.
The story is the MI300. It is AMD's AI accelerator, akin to NVIDIA's H100 GPU, which is used to train large language models or foundation models. The news is that it will go into production and ship by the end of the year, but the rate at which it will show up as substantive revenue is really what the market's trading on here. Full year 24, Lisa Su, the CEO of AMD, expecting $2 billion of sales for the MI300.
Shares right now are up about 7.5%. And WeWork having its worst day since it went public back in 2020. It comes after a report from the Wall Street Journal that the company plans to file for bankruptcy as early as next week. We have more from Bloomberg's Abigail Doolittle.
Now, the company missed interest payments back on October 2nd. That kicks off a 30-day grace period. Missing the payment would be considered a default. WeWork declined to comment on what the company called speculation, and yet went on to say that there's a forbearance agreement in those bonds that allows them to have positive conversations to try to work it out.
Shares right now, they are plummeting, down about 50%. And Kraft Heinz boosted its adjusted earnings per share guidance for the full year, beating estimates. The maker of its popular mac and cheese and ketchup, it announced a few executive changes and also said it's dividing its international business into 3 zones. Kraft shares are up about 3%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio and streaming live on YouTube. We mentioned the story earlier this morning, Schwab laying off 2,154 people. That's about 5% of their staff, and I guess it's raising a lot of questions. Is that just the beginning of what's going to be a reduction in headcount across Wall Street after a very difficult 2023 from a financial perspective? Let's bring in our expert here, Sonali Basak. She covers Wall Street for Bloomberg News, Bloomberg Television. Sonali, what do you make of the Schwab news? Is it specific to Schwab, or do you think we might see more of this across the street?
It's definitely not specific to Schwab.
Okay.
And we did know that this was coming, however, when it comes to Schwab's headcount. We knew that they were taking cost-cutting measures. This includes with real estate as well as with jobs, but it's painful, isn't it?
Yep.
And we knew that the environment was bad across many different business lines across Wall Street. But you take Schwab, where you have thousands of people who are being let go on the heels of this kind of, clamp down on costs. You have Citigroup, which is also facing very severe pressures on their headcount, given that they are getting rid of layers of management across the entire globe. You have the annual kind of culling, where most of the investment banks do tend to think about, let's say, 3 to 5 and sometimes even 10% of their staff at the end of the year as they shape up into next year. And by the way, this has already been a bad year. And so when you take all of that into account, it's a pretty tough season for a lot of people out there.
So what do you think are the specific areas where we're going to see job cuts? If you break down investment banking from, trading, advising, if you look at
All the
wealth
different
management,
business
asset management,
lines,
exactly.
So some things that are interesting to look at here. Yes, the deal market has had more than $2 billion wiped out in fees alone, let alone volumes is even more than that. And so, of course, mergers and acquisitions generally has been in a tough spot now for years. We've already seen lots of layoffs there, however, so maybe there's a little bit of pressure taken off, but you will still see that culling of the underperformers. In investment banking, you have IPOs that have been down really meaningfully. There's a hope of an IPO revival next year, but the IPOs this year have not done all that well. And so the idea that the IPO market can come roaring back at the beginning of next year is still very much in question. Matt, you and I are going to talk to one of the top bankers at Citigroup tomorrow around 1 o'clock to talk just about that dynamic. We also are seeing debt underwriting start to come back. So that's a little safer than, say, traditional just mergers and acquisitions. Restructuring bankers are still in demand right now because we are seeing bankruptcies starting to tick up. If you are a banker that is really good at understanding balance sheets, debt costs, future debt costs, and ways to get more debt at a reasonable price, boy, are you in demand, because that is the type of deal making we're seeing in this kind of environment.
Is there a sense that Wall Street is running lean these days, or maybe running a little bit heavy in terms of headcount? I mean, as you think about
It's heavy still.
Yeah.
It's still heavy, and if you think about all the hiring that has happened into 2020 and into 2021, obviously these banks were not expecting years of prolonged slumping activity here. But what's interesting about it is that kind of at the very high end of investment banking or even trading, those bankers are still tens of millions of dollars here, right? Like there's still a lot of demand for traders in the hedge fund community, but there's even a sense that a lot of performance is starting to turn even in that regard. Private equity firms, deal making slumping, hard to imagine them taking on a lot more headcount and even potentially starting to be happy with at least the attrition, if not start to also let people go. And back office as well. Things are getting automated at a faster rate, and it's something to look out for. There's a question about research in the future and whether there's room for so many research analysts at a lot of these banks. You surgically look across every business line. These efficiency ratios at a lot of these banks, to the point that you're making, are still quite high. In many cases, above 65%. And so, yes, there's definitely room to cut.
Paul, what you want to do is lose out in a competition to become CEO successor.
Yes.
That's the way you get paid on Wall Street. Don't win.
That's an extra $20 million
That's
right
right.
there
Exactly.
for you.
Double
On
your
top of the
salary.
$20 million that you already get.
Exactly right. All right, Sonali Basak, thank you so much. We appreciate that. Sonali Basak covering all of Wall Street for us, talking to us about the Schwab news. The stock's up 1.8% today, but down 36% year to date.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Katerina Saraiva, economics reporter for Bloomberg News. She's got a piece out there on the unraveling of historical labor gains made by black men amid the Fed's inflation fight. So she's going to join us in studio. Fascinating discussion there. Plus, we're going to check in with Chris Whalen. He's a founder of Whalen Capital Advisors. We talk banks. And we talked to Chris Whalen, just banks and what's happening there. Kelly Kowalski, portfolio manager at Mass Mutual. She's going to join the show, discuss her market outlook and maybe what she's expecting from this Federal Reserve at 2 p.m. Wall Street time. But first, let's kick it all off. World and national news in New York City. Denise Pellegrini.
Yeah, and one of the things we're really keeping a close eye on is financial markets here. And we do check the markets for you all day long here at Bloomberg. And just what we needed on Fed Day, right? We have signs now of more strength in the job market with the labor market setting the stage for that Fed announcement. We will have live programming, of course, with the Fed Decides coming up at 1:30. And of course, we're live here walking you up to that moment. U.S. jobs unexpectedly climbed in September for a second month, and that underscores the persistent strength of labor demand. Ed Yardeni, president of Yardeni Research, watching it all. He says the labor market remains relatively hot. And he says, don't exactly expect a wildly dovish Fed, even going into 2024.
I think they're going to say the same story is going to remain intact, which is we're going to remain restrictive. We're not anticipating cutting interest rates anytime soon. And if we do it next year, it's more likely to be 2 cuts rather than 4 cuts.
And Yardeni there on Bloomberg Surveillance with us right now. We do have some strength for stocks, a little bit anyway. The Dow up 0.3%, 104 points higher. The S&P 500 better by about 0.5%, call it 22 points higher. And the NASDAQ up about 0.7%, up 91 points. Yield on the 10-year right now, it is 4.80%. So that's not exactly indicating a lot of sentiment about a Fed rate hike today, and indeed that's what we're hearing is probably no Fed rate hike today. Apollo Global Management shares, they jumped the most intraday since April of 2020. They're up by more than 7% right now. That's as investors look past a private equity deal slowdown and cheer momentum in the firm's massive credit business. JP Morgan said to be seeking out a partner for private credit push. We'll be talking about that as well. And just circling back here, spot gold right now, it's down by about 0.3%. Looks like 1978 an ounce. Crude oil, it's higher by almost 1.5% at 82.16 a barrel. And that, guys, is your Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Radio. Nice little pop on the stock market today. The S&P up 0.5%, kind of close to its intraday highs. Let's see what's happening underneath the hood. Nora Melinda.
And third day in a row, by the way.
Third day in a row, by the way. Maybe November is going to be a nice month, starting off well. Bloomberg Equities reported. Nora Melinda joins us here in studio. Nora, what are you looking at?
Got a few stocks here for you today. Looking at Estee Lauder, those shares are really getting battered this morning. The beauty giant slashed its full year forecast on troubles in China and the Middle East. Of course, we know that this is a brand that owns MAC and Tom Ford, but those brands have really been floundering in its crucial travel retail business in Asia due to weaker than expected demand. So we're really seeing a plunge today. Those shares are down as much as 21%, and there's lots of frantic investors right now. The CEO did say that, quote, while we had a better than expected first quarter, we are lowering our fiscal 2024 outlook given incremental external headwinds, namely for the slower growth and overall prestige beauty in Asia travel, retail, and in mainland China.
It's funny, one of my memories...
Blue button.
Thank you, Blue Button. One of my many memories of the beginning parts of, or just the pandemic in general, was how what's the store across the street?
Sephora.
Sephora. Packed every day. There were people in there every day. I don't care what lockdown.
During the pandemic?
Yes. People were going in there and buying stuff. I mean, I was just like, holy cow.
For Zoom rooms?
I don't know what it was for, but I was like, boy, that's a resilient business there. People need their makeup and stuff, but I guess Estee Lauder, they're calling out China. I mean, it's just the economy is weaker than expected.
They have so many, I mean, brands. I know them from like going to the makeup room, right? They have Bobbi Brown, they have MAC, they have Clinique, they have Tom Ford, they have Joe Malone. And by the way, when I always think Estee Lauder is some like super fancy French lady from Paris, like Coco Chanel.
Yeah, no.
I'm pretty sure she was from Queens. Yeah. And started the business like with her husband in the 1940s.
All right, we'll go Google that and get back to you on that.
The more you know. I was actually hearing from an analyst who was on Bloomberg Television this morning. She said that while most sectors struggle from lots of competition, that beauty is actually one of the few sectors where the more growth that there is, the higher the profitability goes for individual companies.
Boom. How about the chip business? Our good friends at AMD having a nice day.
Yes, that stock is really soaring, and its biggest gain since May. The company said that a new AI chip will generate $2 billion in sales next year, fueling optimism that demand for the chip will offset a slump in orders.
Is this an AI thing, or is this just a regular chip?
This is AI.
Oh, of course, okay.
It's called the MI300 processor, and it's set to begin shipping in the coming weeks. It's going to compete with some of NVIDIA's products in the market for AI accelerators.
WeWork is still a public company?
Apparently so.
I forgot. I'm like, that's not public anymore, is it?
It's too much of a fun name for me, but of course
and
that's...
ticker. The ticker's just We.
Okay.
My favorite. But it's a penny stock, and at this point, even though it really is a penny stock, so many investors are really still following it. The co-working space is seeing its worst day on record, down more than 50%. A report came out saying that the company plans to file for a Chapter 11 bankruptcy in New Jersey as early as next week.
I don't know. It made sense at the time. You know, everything was flexible. Everybody was kind of bespoke. Everybody's working for themselves instead of working in a Starbucks. Why don't you go get a little office and pretend like you're professional?
Right. A great pandemic idea, but here we are sitting across from each other in person.
Exactly. So I don't know how that plays out, but amazing story. Down 51% today, down 98% year to date. So just brutal there for WeWork. Thank you very much, Nora Melinda, equities reporter for Bloomberg News. We want to get to a piece here from Katerina Sareva, Federal Reserve and U.S. economy reporter for Bloomberg News. Really fascinating. Black men's historic labor gains unravel as Fed fights inflation. Katerina, talk to us about this story. What did your reporting dig up about kind of the labor market for African-American men?
Yeah, so, it was really interesting because we were seeing a lot of really outsized gains in employment for Black men at, the end of last year and the beginning of this year. And we were like, wow, this is amazing, kind of some historic numbers. And this is traditionally a part of the labor force that struggles the most. They face some of the biggest headwinds. So, it looked like really positive news. And then that kind of took a turn late this spring. And we've actually seen some of those gains reverse. And of course, we're at a time right now when the Fed is rapidly, had been rapidly increasing interest rates, is still keeping policy very tight, has said it wants to see the labor market cool off a little bit. And so, what we're seeing right now is perhaps like the first indications of a weakening labor market, which often means pain first for a demographic like Black men.
Why men specifically? I mean, why Black men rather than Black women or another identity group?
Yeah, I think we can look at Black women as well. Also saw some interesting, some good gains, but Black men saw really incredible gains when the labor market was kind of at its strongest.
I see. So because they did so well, it's
Yeah.
why we're looking at
They were the group that was by far not only had recovered its pandemic employment losses, but was doing far better. And this was above any other group. And I mean, I think the big reason for this is because of this consumption that we had in the economy, people buying so many goods, so many like material things. And that really drove some of these sectors that disproportionately employ a lot of Black men.
Yeah, I'm looking at your story here, and I mean, it kind of what's interesting is kind of thinking about where the economy is, where the growth is, and we were in such during the pandemic, products. Now it's more experiences, and maybe that hits, for example, the trucking industry, for example, lost a lot of jobs here. So I guess the question is here: does this feel like? Do the economists feel like this is going to kind of put this group back to kind of where it was pre-pandemic, back to kind of what was the normal, I guess?
Yeah, perhaps pre-pandemic. I mean, it kind of depends. We haven't seen it completely revert back to, give up all of those gains that Black men had seen, but we're certainly seeing it decline a little bit. So I think the big question right now is, if we go into a full-blown recession, I mean, that could mean even more pain, right? At that point, you could see deep job losses that could take us back to pre-pandemic or even worse. Because if we do see a contraction right now, it would be one of those more kind of traditional economic recessions where you see the good side gets hit first, and that always means men get hit first across all demographics because men are disproportionately employed in those industries.
By the way, a couple of the men that you interviewed for this piece, I'm looking at Stacey Cowsett, for example, or others that have jobs in, for example, as a janitor at a military base or as a factory worker at Amazon. They were able to get, and by the way, Stacey was doing both of those jobs, right? They were able to get health care and, earn money, but their wages couldn't keep pace with inflation. If you step back and look at it, Katerina, how have workers in general done keeping pace with inflation?
Yeah, I mean, I think wage gains in general have kind of just barely kept pace with inflation. You're seeing wages at the lower end of the income spectrum do a bit better than inflation, but not a ton better. I think in particular, what we found really interesting is that even though Black men have experienced, these outsized employment gains and we're doing really well before this latest downturn, the wage gap between white and Black men hadn't budged. That was kind of at where it's been historically. So it's interesting that even with more job opportunities, seemingly more competition for workers, that wasn't impacting this persistent wage gap.
I also, when I see a story like this, connecting such specific groups or industries to monetary policy, I just wonder how exacting Jerome Powell can be. I mean, he's working with a pretty blunt tool, right?
Yeah, for sure. And I mean, I think they've talked about that a lot. There have been calls for them to target things like the Black unemployment rate, but I think that's difficult in a practical sense because it is a very blunt tool. They can raise or lower interest rates, and that's about it. So they can't. The fiscal side of the economy has many more kind of targeted measures that it can deploy. So that's really tough. But I mean, I think what's been interesting is that in the past few years, you have heard the Fed talk a lot about how the lessons it learned from those years right before the pandemic, like 2015 to 2019, because at that point you had a hot labor market, you had a lot of demand for workers, and it really benefited some of the most sidelined groups. And you've heard Chair Powell say he would like to get back to that. But right now, because inflation's high, they point to the hotness in the labor market and say that it's a bad thing. So it's kind of interesting that we're hearing both of these things.
And Katerina, when I read your story, talk about some of these jobs in warehouses or factory floors, it seems like a lot of those are really at risk of automation for everybody that's employed there. So is automation kind of a significant headwind for this group going forward?
I think for sure, yeah. Automation, I think it's been shown that the jobs that are most in danger are jobs that require, not a ton of education, kind of entry-level positions. those are definitely at high risk of automation. And yeah, things on factory floors and warehouses, even trucking, right? We hear about maybe automated trucks one day. Obviously, that's not happening today or in the near term, but I mean, it's a future that I think a lot of us can imagine. So yeah, I think that's gonna be a significant headwind for people that are kind of already in a pretty vulnerable position in the labor market.
Yeah, I would guess automated trucking is coming sooner than you think.
I don't think so.
I'll
take the under on that one, dude.
No, I mean, all right. Well, it's a different segment, right?
Well, I don't know.
Discussion for different.
Well,
one thing I wanted to ask, because Katerina, a lot of times when we talk about these stories, then listeners will go into the Bloomberg terminal and click on them, or go on Bloomberg.com, and if you search for the headline "Black Men's Historic Labor Gains Unravel as Fed Fights Inflation," they're going to see that you wrote this piece with Augusta Saraiva, and then people will ask, "Are you sisters? Have we, are you married? Are you cousins? Like, or is it just total coincidence that two women with the same fairly unusual last name, happen into a pretty wonky job in journalism covering, the Fed and the labor market?"
Yeah, it's for sure hilarious and weird, and we often get crossed emails, as you can imagine. We are not related. We are on the same team, so it's pretty confusing.
Out of here.
We're both of Portuguese. I'm Portuguese, she's Brazilian, and it's not too unusual of a name in Portuguese-speaking.
But are we saying it correctly? How do your parents say Saraiva? Saraiva?
Yeah, Saraiva. Yep.
Saraiva.
Okay,
yeah,
so
it means hail. Like ice.
All right, well, that's not even the biggest issue I have with Katerina. And by the way, your story is fantastic. You and your supposed, I don't know, people that share the same last name. She went to the University of North Carolina at Chapel Hill. That's a problem.
Oh.
But I think I've been quite
She's a
respectful.
Tar Heel.
I think I've been courteous. I haven't called her out on her. Are you guys even going to have a basketball team this year, Katerina?
Oh, that's the most difficult question you've asked me.
All right, well, as you can tell, I went to Duke.
I think we will.
Yeah, I went to Duke.
Yeah.
So anyway, great story. Some good data in there. So like a Matt Winkler would love this kind of story. Lots of data, lots of numbers, all that kind of stuff. So Katerina Saraiva.
Saraiva.
Yeah, just Saraiva. Katerina Saraiva. Yeah. She's a reporter. She's down at Bloomberg News, down in our Houston bureau. Saraiva. I would have laid 100 to 1 there was something like some kind of relation there.
Yeah, I sort of would have thought so
I've never heard that
too.
surname before. But anyway, great story, good stuff. We appreciate getting a little bit of Katerina's time there. Looking at the markets here, a little bit softer than where we were kind of an hour or so ago. Still S&P up about 0.4%, Nasdaq up 0.6%. It is Fed Day, folks. 2 p.m. Wall Street time. We'll get the statement. 2:30 we'll get the press conference, and Bloomberg Surveillance will have you all set at 1:30 p.m. Wall Street time. Let's get some company news right now with Lisa Mateo.
You got it, Paul. CVS Health's cost-cutting strategy, that's paying off as it expands its healthcare business. The drugstore chain posted higher sales and profit in the third quarter and reaffirmed its full-year adjusted profit outlook. Bloomberg's Steve Rappaport has that story.
Lisa, CVS topped estimates as the drugstore chain cuts costs and dives deeper into the healthcare business. Adjusted earnings came to $2.21 a share, up 4 cents from a year ago. Rhode Island-based CVS has struggled with rising costs in its pharmacy and insurance businesses. The company warned investors in August that those issues will take a toll on profits over the next 2 years. CVS eliminated 5,000 non-customer-facing positions to streamline operations and reduce expenses.
Now, at the same time, CVS and its rival Walgreens are facing walkouts and protests from its workforce. More than 2,000 pharmacists plan to walk off the job this week to pressure the drugstore chains to address poor working conditions. Now, pharmacists say they're frustrated with staffing levels. Shares right now, well, they're down about 2%. And Zillow reports after the bell today. It comes a day after a jury in Missouri found the National Association of Realtors and other housing industry players guilty of colluding to maintain those high brokerage commissions for agents on home sales. And the jury awarded nearly $1.8 billion in damages in the case. The Justice Department also criticizing how real estate agents are paid. In a worst-case scenario, the federal government could seek to ban sharing commissions. We'll check in with Zillow right now. It's up just a fraction. Brokerage shares, though, they've also been fluctuating. We have Redfin right now down just a fraction. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 12:21 on Wall Street. We check the markets for you all day long here at Bloomberg's. It's Fed Day. Stocks are higher, but there are a lot of concerns weighing on the markets. We do have that stronger than expected jobs report, with the Labor Department saying U.S. jobs opening unexpectedly climbing in September for a second month. And that does underscore the persistent strength in the job market, just what you needed if you were worried about Fed rate hikes, right? So Ann Maletti, head of active equity at Allspring Global Investments, says by and large companies are meeting expectations on quarterly results, but you really don't have a lot of visibility about what happens going forward.
It's pretty murky when you talk to the CEOs and CFOs, and that's what we've been hearing prior to earnings season as well. So you're not getting any more clarity from earnings than you are from the economic data.
And Maletti with us there on Bloomberg Surveillance. The Dow right now up about 0.2%, up 59 points. The S&P 500 up 0.4%. That translates to 18 points. And the Nasdaq up 0.7%, 84 points higher. We do have the yield on the 10-year right now, 4.81%. Spot gold, it's trading lower, down by 0.3% at $19.79 an ounce. Crude oil, though, it is surging today, up more than 1.6%. Call it $82.32 a barrel. Estee Lauder getting slammed today. That stock dramatically lower. The beauty giant slashing its full-year outlook on troubles in China and in the Middle East. And that, guys, is your Bloomberg Business Flash.
All right, Denise, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well, so check us out there. It is Fed Day. We'll have complete coverage starting at 1:30 p.m. with Lisa and Tom, simulcast radio and TV. It is Fed Day. We want to talk to Chris Whalen. He's the chairman of Whalen Global Advisors. Hey, Chris, I'd love to get your thoughts on what you think the Fed should do and why.
Well, I think they should stop hiking Fed funds rate before we break something. We're pretty close to that point now. And I think they need to, try and articulate to the public and the policymakers what we can expect going forward. There was a fascinating letter from the mortgage bankers and the home builders and the realtors a couple of weeks ago that said, can you give us some guidance? Because the guidance the Fed gave us before about transitory inflation was clearly wrong. And a lot of companies use that guidance in planning their business. So I think the Fed has to be very careful what they say in the future about inflation and other benchmarks, because people sometimes take them at face value.
Well, but they've been saying for a couple of years that they're going to hike rates like we've never seen it before to try and quash inflation. I mean, they've been telling everyone in the market hasn't believed them, for 2 years almost.
But they've caused a lot of inflation, though. Look at housing. We're not going to take that back easily. We're going to deflate housing 20, 30%. No, we're not going to do that because they know that there's a deflationary aspect out there still, and it's called bad debt. When debts go bad, that's when you get deflation. So I think the Fed is, as Craig Torres was saying this morning, they're in risk management mode now because I think they know they can't go any higher without really seriously causing something to break in the world of credit.
Where do you think, by the way, we're going to see debt go bad? We've been talking all morning with people about high yield, and no one is concerned. Spreads are relatively tight. And the answer, they tell us, is that all these companies, were so much smarter than Janet Yellen. They got all their financing under control when rates were zero, and they're in a great situation now. But it seems hard to believe.
Well, they're getting the financing done, not necessarily on advantageous terms. They're doing a lot of discount issues, for example, to keep the coupon down, but you issue the bonds at 8. Now, when the bonds get redeemed, that's going to hurt. So I think there's a lot of ways people are adjusting to this. But, to be honest, you see the carnage now in commercial real estate. I think every day you see a headline crossing the screen in commercial, and what you don't see is the other 5 events that are private, and you won't see them until they hit the courts. So believe me, there's a lot of destruction going on right now on the commercial side, and it's the opposite of 2008. It's the way I would put it to you. This is not consumer, and you're not seeing it yet in consumer-facing vehicles like fintech and that sort of thing yet. But, so as this reprices, you'll see more.
Yeah, I want to, that kind of goes. So you think we'll see it in, I guess one of the areas you think we'll see a break will be in commercial real estate. Do I understand that right?
Oh, yeah, it's happening now.
Okay.
I mean, look at it this way. Most banks have 50 cents worth of equity in commercial loans, okay? So that means they'll wipe out the quote-unquote owner, and then they'll end up owning the asset at 50 cents on the dollar. Now, even then, though, they may not be able to sell it because, in a rising rate environment, it's hard to sell assets, and it's hard to sell dead banks. Usually when the FDIC is taking care of dead banks, the Fed's already dropped interest rates. So there's a kind of a synchronization problem right now.
Yep.
The Fed is trying to address inflation, but we still don't have a recession. I mean, home prices in New York State are still going up, for Christ's sake. We're the weakest state in the U.S. before COVID in terms of pricing.
So do you expect some big financial names to come under pressure? They're already sitting on hold-to-maturity portfolios that, are worth far less than they'd like us to know. And commercial real estate, we thought was the next shoe to drop. Now it looks like it's falling. Who's going to get hurt?
It's an earnings problem, Matthew, more than a systemic problem. I don't think the Fed will let it get that far. But the inflationary implications of, say, another bank failure are huge. Because if I can't find another bank to buy the dead bank, I have to liquefy the whole thing, which is why the Fed had to lend the FDIC $200 billion. So, I think that if we see another problem in the credit markets of size, the Fed's going to have to retreat almost immediately. I think that'd be good for a point on Fed funds because you can't deal with problems of credit unless rates have already essentially conceded. You know what I mean?
Yeah.
If people think rates are going up, how do I sell those assets? Even at a discount. FDIC will normally give you a 30% discount to create new equity under the asset. But even then, you might have a hard time getting buyers in this environment. So the funny part is, to your point, is there's people out creating and buying assets today at really crazy prices because there's cash on the sidelines. There's a huge amount of cash on the sidelines. And what they're waiting for is a signal that we're done, a real signal.
Yep. We're done raising rates. And it seems like the market feels that way right now. The question is, what happens with the economy, in Q4 in 2024, and then does the Fed have to cut rates? And not by 50 basis points, but maybe more.
I think they're going to try and keep rates more or less where they are because they realize that volatility has not been helpful for a lot of businesses. And I think they also realize that housing particularly is going to get absolutely crunched in the next 12 months. We're going to take another third of capacity out of residential mortgage lending. And you're also going to see capacity coming out of commercial too, because there's not much volumes. I sit with the loan production team at Cohen in New York. They're not busy right now. And the reason is that the buy-side investors, who typically are the cash buyers for commercial loans, hotel loans, that kind of thing, they're on the sidelines too. They're trying to figure out where price and where value is today. And most of them have already filled up their allocations for this year. So they're happy to go into the end of the year flat. That's not helpful to people who need to do deals. You know what I mean?
Yep.
So
well, what is going to happen, Chris, to those markets? I mean,
lower volumes.
No one's going to want to sell. No one's going to want to sell a commercial building if they don't have to at a 60% haircut. Nobody wants to sell a residential home, right? Because you're not going to remortgage to get someplace else at 8% when you're in at 3%.
Well,
so
resi's different though.
Yeah.
Remember, commercial for the last 75 years, the assumption has been that the asset would go up in price, and we could just do interest only, and that was very much the style in the commercial real estate business. Now you can't, because when the lender comes to you, if the rent roll is down, the building is worth less. They want equity. You've got to put more cash in to roll the mortgage. That's the difference in the dynamic today. And as the Treasury deficit goes up, guess what? The Fed has to hold more cash. And what do they do with that cash, Matthew? They collateralize it with Treasury bonds, for Christ's sake. Makes no sense. So
it makes sense to Sam Bankman-Fried. He would get that. Sounds like something FTX would have done.
But listen, they're raising rates already, and we're going to make collateral more dear at a time when we're producing nothing on the mortgage side, by the way. We'll do $1.5 trillion this year in new coupons. And Treasury issuance will be big. But still, and they're going to be buying back low coupon bonds too while we're doing all the rest of this stuff. That's going to be interesting.
All right, Chris. As always, really interesting discussion. Chris Whalen, Chairman.
Breaking the Whalen silence.
Breaking the Whalen silence.
Which I've heard Tom say that a million times. I still am not 100% sure what it is.
But that's a Tom Keenism. All right, Chris Whalen, Chairman, Whalen Global Advisors. Thanks so much for joining us there. Matt, I'm waiting to see just a random 3rd Avenue, 48th Street, Midtown Manhattan office, big office building change hands. And I want to see what the price is and what the discount is from,
But everyone we ask says it's going to be 50, 60% down.
Wow. And if I don't know what happens.
I just heard Chris saying the same thing.
Yeah.
And the reason you're not going to see it happen is, as he said, it's a rising rate environment. They don't want to pick it up now,
Yep. Unless you got just tons of cash on the sidelines. You can put a lot of cash in there, but that's not how the real estate folks like to do that. Right now, let's head down to Washington, D.C. We've got more than national news with Nancy Lyons.
Thanks, Paul. After several days of humanitarian aid flowing into Gaza, there are now reports of some foreigners being allowed to leave Gaza. Bloomberg's Oliver Crook is following developments from Tel Aviv.
The first foreign passport holders have crossed from Gaza into Egypt, and we also understand that Egyptian ambulances have gone into Gaza to get some 80 wounded and going to be treated in Egypt in field hospitals there. So that is a meaningful development on the Rafah border in the southern part of Gaza into Egypt.
Bloomberg's Oliver Crook in Tel Aviv. Al Jazeera Television is reporting the Gaza Strip's government agency in charge of the Rafah crossing has a list of more than 500 foreigners who've been cleared to enter Egypt. The issue of aid to Israel is becoming contentious on Capitol Hill. The Biden administration says any standalone aid package for Israel, an option preferred by the House, will be vetoed by the president. And Bloomberg's Anne-Marie Hordern says that's not the only hurdle.
You're actually going to see Mike Johnson, the Speaker of the House, come up against Senate Minority Leader Mitch McConnell, who wants to see a bigger, broader package. So there's going to be not just confrontation between House Republicans in the White House, but also House Republicans and other Republicans in the Senate.
Bloomberg's Anne-Marie Hordern reporting. Well, it is possible that Donald Trump Jr. and Eric Trump will take the stand as early as today in their father's civil fraud trial. Both are also defendants in that case. New York Attorney General Letitia James alleges that all three were central figures in a scheme to inflate the former president's assets by nearly $4 billion a year to get better terms on loans and insurance policies. Both sons will likely be asked about their alleged role in preparing annual financial statements, which are at the heart of the case. Global news 24 hours a day, and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 12:40 on Wall Street. We check the markets for you all day long here at Bloomberg. Stocks are higher. It's Fed Day. We did see that stronger than expected report when it comes to the job market, but that didn't seem to rattle investors too much. Ed Yardeni, president of Yardeni Research, says even though you can park your money in treasuries right now, he still thinks stocks are a good bet.
At this point, I think that, 5% is awfully attractive, but I think over the long run, we're going to find that this correction is offering opportunities in technology, in financials, and even in energy.
And Yardeni speaking there on the Bloomberg Surveillance podcast. The Dow right now, we are off session highs, though. It's up just fractionally, up 13 points. The S&P 500 up about 0.3% now, up 11. And the NASDAQ, it's up about 0.5%, up 64 points. We have this headline coming in from Silver Lake. It's said to be seeking Mubdala backing for Endeavor Group. Abu Dhabi Wealth Fund is in talks to commit capital to take over. And that tie-up does underscore the strong ties between the PE firm and Mubdala. We'll be tracking that for you here on Bloomberg Radio. Another thing we're tracking for you right now is the 10-year yield. It is 4.82% right now. COMEX gold, spot gold, it's down by 0.3%, 1976 an ounce now. Crude oil, though, it's still higher, but nothing like what we had before crude now, just up about 0.5%, 81.41 a barrel. And JP Morgan Chase searching for a potential partner to grow its private credit business. And we'll have more on that throughout the afternoon here on Bloomberg. And that is your Bloomberg Business Flash.
All right, Denise, thank you so much. We appreciate that. Denise Pellegrini with a Bloomberg Business Flash. Looking at the 10-year yield here, as Denise was just pointing out, 4.82%. If you go back to just, early May of this year, it was 3.34%. So 150 basis point move up in yield on your 10-year. And remember, folks, in the bond market, yield up, bond price down. So tough time for the bond investor out there. And it was a tough 2022 as well. Let's see where we go from here. Kelly Kowalski joins us. She's a portfolio manager at Mass Mutual. So Kelly, it's been 2022 for the fixed income folks, just a brutal year. And this year, not a whole heck of a lot better here. What's your call on fixed income these days? I mean, I'll go buy a 2-year treasury and take my 5%. I'll be happy with that. But you professionals have to do this for a living. So what's your call here?
Yeah, thank you so much, Paul and Matt, for having me today. So at Mass Mutual, we really take a long-term view when it comes to interest rates. And the nice thing about being a portfolio manager for an insurance company is that we're not managing to a benchmark like the Bloomberg Ag, for example. We match the duration of our assets to our liabilities. So we have that offset. Having said that, I do think yields are exceptionally attractive here. And one of the things that our 7,500 financial advisors are emphasizing to their clients is that bonds are relatively more attractive